Welcome to a special NVIDIA-themed episode of the Opening Bid Vodcast. I'm Yahoo Finance Executive Editor Brian Sozzi. All things NVIDIA, lots of focus on our platform after NVIDIA's earnings. We're seeing the stock go from gains to losses all over the map. Very important off the jump here. I want to get you to what Jensen Huang and CFO Colette Kress, in my view, some of the most important things they said on that earnings call last night. Take a listen.
We're going to have to continue to scale as demand is quite high and customers are anxious and impatient to get their Blackwell systems.
Blackwell fully ramps, we can improve our cost and our gross margin. So we expect to probably be in the mid-70s later this year.
There we go. You heard it from two top executives in NVIDIA. I want to get to my man here, Dan Halley, Yahoo Finance's tech editor. Dan, you were on that earnings call. I can't say that I'm surprised that we're seeing really the stock swing between gains and losses here. You had Jensen say, guys, look, demand is strong. And you had Colette say, look, the first quarter might be the bottom for gross margin this year. Get that ramp in the back half of the year. I've seen everybody come out here and defend this stock this morning, Dan.
Yeah, it seems like going into it, there was kind of a wishy-washy feel from Wall Street. The stock had been down the past few days. This is, the AI company. It's been the AI company. It continues to be the AI company. It will be for the foreseeable future, at least. But it just seemed like during the call, there was a lot of almost putting out fires that didn't necessarily exist within the company, but did for the stock price. And so, an analyst worried about various things within the company, whether that's tariffs, whether that's export controls, whether that's the rise of ASICs or those chips that the likes of Google and Amazon and Microsoft are working on their own. They hit on all of that. And so that seemed to be the tenor of the call overall. And yeah, you saw during it, the price was down, up at first once the print came out, dropped down. During the call, it was kind of wavering back and forth between positive and negative. But, I think that was really the kind of key takeaway for me was, putting out these fires that existed for investors, but again, not the company itself.
Dan, I saw no ratings cuts on NVIDIA this morning. I saw one price target cut this morning. Didn't really see estimates move anywhere. And I have to think, you think the street is, I guess, do you think we get the upside that people expect with that gross margin from NVIDIA this year as Blackwell ramps? I mean, Colette talked a little bit about it in the earnings call, but do you think we can get beyond 73%? What has to happen for it to go right?
I think, she pointed out during the call that, look, this is, so I think there's two things going on here, right? They're ramping Blackwell, so it's still a new technology for them, right? I mean, they had to kind of develop new ways of new interconnects for the actual servers, right? If you look at this thing, I think it's 1.5 tons, right? The full server. They call it a spine in the back. I was looking at when I was at CES, I was looking at the plugs for it, I
love that you're looking at the plugs there.
Oh yeah,
that's why you are our tech editor. You're looking at NVIDIA chip plugs.
It looked like something out of Ghostbusters, the size of it. I was like, who's what? It's like an industrial kind of thing. So that's. The AI explosion kicked off where their Hopper platform was already out and rocking, right? So it's not like they were developing this. It's not like they were rolling it out. So that's why the margins then were just so great. They were already ramping and then some. Blackwell, they still needed to develop this and ramp, and so as a result, margins were slightly compressed to the low 70s, right?
They're still pretty damn good.
Crazy.
70% plus margins. I dare you to find another company that has margins like this.
Yeah, it's software companies, maybe yes, but a hardware company. But I think, as she said during the call, once this is fully ramped up, we're going to get back there. Now, I think one of the things to point out is they also discussed Blackwell Ultra, which is the chip that we'll probably learn more about at GTC next month, and then they hit on Vera Rubin, which is that. I think they called it the next tick, where you're going to get the next generation. So Blackwell's predecessor.
Hang with us, Dan. We want to bring in someone else who has been making really bullish NVIDIA calls on opening bid before. That is Eric Jackson, EMJ Capital founder and president. Eric, always nice to get some time with you. Are you surprised by this reversal we're seeing NVIDIA off the jump here this morning? I have to be honest, Eric, I'm not, but I don't want to put words in your mouth.
No, I thought it was a subdued reaction last night. I think this is going to be met with a positive reaction for the remainder of today and into the next few days. the fact is, Brian, I mean, this is a stock that's treaded water really for now coming up on 9 months, really. So a lot of expectations have been tamped down. It's the company sort of shut the lights out on so many metrics last night. But I guess their biggest problem is that when you do 40 billion a quarter, it's kind of hard for the street to say, how does this company get to 60 billion a quarter? In terms of getting excited about the next leg of growth. And I think that's what sort of held the stock back in these last 9 months. And, there was the obvious 1% miss on the guidance for next quarter's gross margins. I mean, obviously there was sandbagging. So, and they're, going to rebound. They guided to mid 70s, which is, as you guys were just saying, it's phenomenal. So, I mean, I think things are good, and I think enough time sort of passed in this sort of consolidation phase where this stock probably can move in the next over the next few months.
Eric, you were in the digital green room, but I'm sure you heard Dan talk about some potential new products coming from Nvidia at GTC. What is it, March 17th, guys? Like, what do you think investors will hear from Nvidia? I mean, Jensen talked a little bit about it on the earnings call last night. Several new products, but do you think that's the next big catalyst, or there could be disappointment there as well from what Nvidia shares?
Yeah, I think everybody's probably going to want to hear more about Rubin, so if they can sketch that out. Now they're getting into sort of like an Apple kind of pacing now, where they're just always sort of guiding a little bit to next year's product that's going to be shipping, which is a little new for them. And get people excited about that. I mean, they've also mentioned that in that March event, they're going to feature a quantum day. This is, of course, after in January when I think it was at CES where Jensen sort of poo-pooed on the whole quantum space and sort of took them down and said it was like 30 years away, and then announced a week later that he's having quantum day in March. So maybe it's not 30 years away. So there might be something interesting there, and how they're going to collaborate with some of the other quantum players to try to keep the latest GPUs exposed to the benefits of quantum.
Eric, this is Dan. I want to ask you talk about how investors were looking for that next leg to get to 60 billion. During the call, Jensen kind of went to pains to kind of explain where they see that next kind of leg of growth coming from. We have obviously the cloud service providers. They said that they made up 50% of sales for the data center this quarter, same as last quarter, and on and on and on. But he did also talk about the consumer side of generative AI as well as the industrial side of generative AI, saying that those are going to be applications that we see more kind of movement in. Do you think that that's actually going to be where we start to see that growth pick up, since right now it really is the data center guys?
Yeah, I do think so. And there are some positive signs. I mean, on the recent Alibaba quarter, they sort of talked about how just in the last few weeks, they'd seen this big shift, albeit over in China, of the hyperscalers there to inference jobs. And so, and they obviously made some big announcements with increased CapEx that they planned for this year, which, unfortunately, remains to be seen how much of that, NVIDIA will get because of export controls. But I think the market is sort of like in a sort of like a show me attitude towards NVIDIA. Like it's one thing to hear Jensen talk about these great opportunities or AI agents for enterprise or whatever. It's another thing to actually see the numbers come in. I think the company has sort of fallen into a pattern in the last few quarters where they guide to a number and then they consistently beat it by 1 or 2 billion, and so that market likes surprises in order to kind of get the stock going and revved up. And so I think that's probably what it's going to take over these next few quarters. Dan is just like for some of these applications to actually bear out in terms of like a meaningful kind of upside surprise in revenue and earnings.
Eric, past few weeks I've been writing a lot about how the Mag 7 is off their 52-week highs, in some case more than double digits. But if NVIDIA's stock is going to reverse losses from last night, going to trade higher, up about more than 2% here in the pre-market, if that's the case, in large part because I think Jensen said, hey, demand is incredible, guys. We're not seeing that slowdown. Yeah. Have we seen a bottom or a short-term bottom in Mag 7 names here?
Well, yeah, and maybe the market too. I mean, just NVIDIA being flat last night was enough to kind of give a shot in the arm to the entire market, which has obviously been down in the last week. But this was sort of like good enough results to kind of make people feel like hey, maybe it's better, we can get back into some momentum names or something, because and that's what we're seeing in the futures this morning. So yeah, I think this is good enough to help the Mag 7 names as well. Most of which have sort of been down, maybe with the exception of Apple over these last few weeks. So yeah, but Nvidia itself, I mean, that's the big thing. After 9 months churning, are they actually going to sort of break out, 2 new all-time highs over the next few months? I think so.
Eric, I want to ask about the other chip companies, because I was watching them kind of move around slightly during the Nvidia call. Intel was up, which they have been since those reports about a potential breakup. AMD was also up. They haven't been doing very well, as well as Broadcom. I guess is this kind of a signal to the rest of the kind of AI / CPU server market that things are going to continue to go well? I know that we had kind of the signals from the big tech companies saying, we're going to be spending, Amazon was what, $105 billion this year. I can't remember. Microsoft off the top of my head, I think it was like 75 or something like that. Meta, gobs and gobs of money. Is this just the next signal that they needed to kind of continue to go up, or is this just kind of, okay, things aren't bad, or just they're not interesting enough at this point, we're going to stay flat?
Well, I think that the NVIDIA is sort of like in a class of its own. The market didn't believe that maybe a year ago, and kept looking to people like AMD mostly as potential competitive threat. And even last night, I mean, I heard some people talking about how the lower guide on the gross margins was due to competitive pressures. I don't really see that. I just don't see anyone having anything legitimate to compete with Blackwell or Rubin for the next few years in terms of AI with Nvidia. You've had some people like Google themselves or Amazon talk about their own interest in designing their own chips, and people are worried about that as a competitive threat. But again, I think that's overblown. So I don't necessarily see Nvidia's results as sort of a signal that it's a green light for the rest of the chip makers. I think what's most interesting about the other chip makers is I know Brian had a chart that he was showing last night on Yahoo Finance, talking about the different PEs, forward PEs for all these chip makers, and Nvidia was at the bottom of the list. I think you had him at like 29 times, Brian, and below Broadcom, below Marvell, below ARM. Now, I don't necessarily see them as deserving like an ARM 85x forward PE, but why is Nvidia, with these, again, consistently good results, trading below at a lower forward PE than a Broadcom or a Marvell? I don't understand it, and so I do think there's sort of opportunity there for Nvidia shareholders to say, hey, this thing can creep up again as people get a little bit more confidence that, hey, Blackwell's delivering and there's more to come and Rubin's on the horizon and so forth.
Not many people do get it, Eric, but maybe sometime eventually they will. Thanks for shouting out that chart. Appreciate you, Eric Jackson, EMJ Capital founder and president. Always nice to see you. Always nice to see Dan Halley too, working those late hours, Dan, studying NVIDIA. We'll be right back after the break, and we're going to dive into the AI arms race. Welcome back to a special episode of the Opening Bid Vodcast. I'm Yahoo Finance Executive Editor Brian Sozzi. We're focused all things Nvidia after its big earnings report. Now I want to focus a little bit on the AI arms race, which in part is helping to fuel the top and bottom lines of Nvidia. Let's bring in Anjane Midha, A16Z General Partner. Really good to get some perspective here, and good to see you, Anjane. You know, I didn't hear anything in that earnings call from Nvidia that would suggest there's a digestion period coming from the hyperscalers. And when we say hyperscalers, we're talking about the companies spending billions of dollars to build out AI infrastructure. It's Amazon, it's Microsoft. How did you hear the earnings call? Did you hear or see any red flags?
First of all, thanks for having me. It's great to be on the program. So I think that's a good question, but the important thing you want to understand is that the physics have changed of infrastructure buildouts, right? Not only are hyperscalers obviously important, but hypercenters, right? Hypercenters are regions, not just companies like big tech companies, but these are governments and nation states that want to do massive frontier AI infrastructure development. And NVIDIA calls these the sovereign AI sector or the regional cloud sector. And the hypercenter buying behavior is accelerating unlike anything we've seen before. And so I guess I saw the opposite of red flags. What I saw is an acceleration of the sovereign AI demand. I think that's driven by the idea of infrastructure independence. This is the world's biggest nation saying it's time for us to accelerate AI adoption. We think AI models are critical national infrastructure. We think these AI factories, data centers that turn tokens into intelligence is critical national infrastructure. And I see that segment accelerating. So I think the physics have changed slightly where while sure hyperscaler demand is important, but hypercenter demand is the story we should be paying attention to.
Just hearing that, it sounds like the market may be underestimating, how much countries are spending to develop AI infrastructure. Is that right?
Yeah, I think that you're going to hear a lot more about these infrastructure buildouts from nation states. Sometimes these are lagging indicators. They often start with with national level sort of nation building agendas. So in Paris, for example, at the AI Action Summit a few weeks ago, the EU announced that they're going to do $100 billion+ infrastructure build out, right? It takes a while for those to translate into Blackwell purchase orders, but that's just it's a supply chain, right? So yes, I do agree with your sentiment that it might be underreported on. It just takes a while for people to realize that nation state priorities are then turning into enterprise budgets.
I love what you recently wrote on, I think it was a LinkedIn post on your page, the need for a Marshall Plan for AI infrastructure. Talk to us about that.
That's the idea that if you look at periods of history where we've had humanity contend with the emergence of a general purpose technology, right? This is a very specific term, general purpose technology, which economists use to refer to a technology that's broadly an economic progress multiplier across a whole society. And we've only had about 20 or 22 of these in human history, right? Electricity, the printing press. And when that happens, nation state leaders start asking, do we build, do we buy, or do we partner? There was a moment like this, and obviously in post-World War II, when a number of countries were trying to figure out whether they would build, they would buy, or they would partner on the reconstruction of Europe. And I think at that point, America led aggressively by saying we'd like an allied plan to bring our allies along in the face of the biggest infrastructure build out that we've seen in modern times. At the time, obviously, it was civil infrastructure. A number of leading American companies got together, funded by American national security interests, to say it's really critical for us to rebuild Europe and to treat Europe as an ally in the face of adversarial nations who don't have America's interests at heart. I think we're entering a very similar era, right? Today, there's basically two major hypercenters, right? You've got the United States and China. And I think every other major country is trying to figure out, do they build, do they buy, or they partner with one of these hypercenters? And so I think a Marshall AI plan for AI would be akin to an AI grid where if you kind of break down the AI stack, right, you've got chips, models, applications, and then ultimately you've got the interface to AI. It might be agents and so on. The idea that we should have strategic alliances across the stack to make sure that America's interests are staying at the forefront of this infrastructure wave, this infrastructure independence era, is quite critical.
And you're really calling out here, Anjane, some really powerful I don't just call them mega trends, like mega forces that are likely to fuel demand, not only for what Nvidia does, AMD. I'll leave Intel out of it for now because Intel's somewhere over there. But how are you putting money to work right now outside of Nvidia? Like, what investment opportunities are coming onto your desk, and what are you saying yes to, and what are you saying no to?
I think we saw the sort of signs on the horizon 2 years ago, where when everybody else was talking about how scale beats everything else, the size of these AI models beats everything else, I think what we were starting to realize is actually these AI models were starting to look more and more like computing infrastructure from the past. So if you look at the history of computing infrastructure, storage, networking, databases, the arc of adoption is quite similar across all of those primitives. You start with new capabilities, people discover a new primitive, engineers often try to figure out what it's good for. And then once the largest companies, the enterprises, start figuring out what it's good for, then you get the era of efficiency. You get the era of cheaper, faster, and more control. You get customers wanting to control and customize the technology for their own specific use cases. That's where we're headed right now with AI models, and that's why we led a fairly large round into a company called Mistral, which is an open source AI model solutions provider. What they do is help the largest mission critical industries, right? Governments, defense, healthcare, finance, that deal with sensitive data that sits on premise. They help them customize models for their specific use case. And this whole reinforcement learning era, this whole reasoning models that we're seeing right now in the post DeepSeek R1 aftermath is all about specialized models in the enterprise. And so we led that investment almost a year and a half ago. We're now starting to see the acceleration of those kinds of specialized models in the enterprise take off, not just in the enterprise, but also at the nation state.
In the last minute or so, Anjay, we always love to get hot takes from our guests here on the Opening Bid podcast. I'll put this one too. You recently had a chance, I believe, to talk to Jensen Huang, Nvidia founder and CEO. Being up close and personal with him, what do you think makes him tick as a leader, and why is he so unique?
Jensen is the closest thing to a walking, talking GPU you'll ever meet. Anything he touches, he accelerates. He's like, he's basically a Blackwell chip personified. That's the closest thing I could give you to understand what he's like in real life. The minute he walks into the room, you understand that here's an engineer who brings with him the efficiency, the acceleration of a chip. I think he lives, breathes acceleration.
All right, well, really fabulous insight. Really enjoyed this conversation. Anjay Midha, good to see you. Thanks for all the NVIDIA analysis. We really appreciate it. Talk to you soon.
Thanks for having me. See ya.
All right, and that's it for the latest episode of Opening Bid. Like I always say, continue to hit us with those thumbs up all over the social media platforms and all those likes. I read all of your comments. I try to answer them. I learn a lot by, in fact, reading them. Much more NVIDIA analysis coming up very soon at 9 a.m. on Yahoo Finance. Shauna Smith, Brad Smith, Madison Mills, and a bunch of guests are going to tell you context and insight on NVIDIA you just can't get anywhere else. Talk to you soon.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Podcast that will make you a smarter investor.
Welcome to Stocks in Translation. I'm your host, Jared Blickery. Welcome to Financial Freestyle.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Welcome to Trader Talk, the podcast that dishes out the market straight up.
Welcome to Capital Gains. I'm your host, Madison Mills.
Welcome to Word Money. I'm Patrick Murphy.
And I'm Dan Coons.
From Wall Street to Main Street to the C-Suite, we are your daily lifeline, because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
Welcome to Yahoo Finance Sports Report, a unique look at sports business brought to you by Yahoo Finance and Yahoo Sports. I'm your host, Joe Pompliano, and I'll be breaking down the financial side of the game for your financial gain. We'll go beyond the headlines, analyzing all the latest sports news, the teams, the trades, and billion-dollar deals, so you and your portfolio will win big. Catch Yahoo Finance Sports Report on Thursdays on all your favorite podcasts and streaming platforms.
Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Shauna Smith alongside Brad Smith, and let's get you the three things that you need to know today.
Good morning, everyone. First up, S&P 500 and the NASDAQ futures pushing higher this morning as investors digest earnings from AI chip giant Nvidia. Shares of NVDA pushing higher after delivering good but not great quarterly numbers on Wednesday. The chip maker at the center of the AI spending boom expects sales to be about $43 billion for the fiscal first quarter. While that number was slightly above street estimates, gross profit margins will be tighter than anticipated as it rushes to roll out that Blackwell product. Meanwhile, shares of Salesforce, CRM, falling this morning after the software giant gave a revenue forecast that fell short of estimates.
Plus, investors processing the latest read on the U.S. economy. U.S. jobless claims rising to the highest level that we've seen since the start of the year amid an increase in job cut announcements. This is coming from both corporations and federal agencies. Also, the second read on GDP data coming in line with estimates, staying at an unrevised 2.3% annualized pace in the fourth quarter. But inflation once again proving to be quite stubborn, with the quarterly read on the Fed's preferred inflation gauge climbing to 2.7%. That was up from 2.5% initially reported.
And traders and officials are digesting the latest tariff news from the White House. The president clarifying tariff remarks today after giving a series of confusing answers about his plans to impose levies. The president said he'll target the European Union with 25% import taxes on their cars and all other things, adding that he'll be announcing it very soon. The president this morning confirmed Mexico and Canada tariffs will go into effect March 4th, and that China will also be charged an additional 10% tariff that same day. Investors digesting the latest news out of Washington and also Nvidia earnings this morning here. Nvidia, as we've got the chart up, let's start there. You're seeing shares pre-market hold on to some of the gains here over the past 2 days. Still just a fractional move higher here, but this is a far cry from that 8.5% move that some of the options contracts were pricing in coming into the start of this. And it really just goes to show how much of a Goldilocks scenario Nvidia really had to navigate itself through, and for some of the margins that investors are anticipating going forward from this juncture.
Yeah, exactly. I think kind of the whipsaw action that we initially saw just in terms of the shares initially being under pressure. Now we're looking at gains here. How do the open very much just illustrates that Wall Street is very much split on this. I think on the surface, when you take a look at these results, obviously there is a lot to like. There's a lot to be encouraged by. CEO Jensen Huang putting some of those fears that we have seen creep into the market to rest when it comes to any delays surrounding delays surrounding Blackwell, and then also looking ahead to even tariffs or curbs for the restrictions here when it comes to curbs here that are expected under the Trump or anticipated to continue to happen under the Trump administration. So I think that very much explains why we are up just about 2%. Of course, gross margins was one of the things that was talked about a lot last night initially when we did see some of that pressure on the stock. And then when it comes to tariffs, I think that's very important here to focus on this morning because it's the other big driving factor. We're just getting headlines here. President Trump saying Mexico and Canada tariffs going to go into effect on March 4th, but then also China is also going to be charged that additional 10% tariff on March 4th. He also went on to say that April 2nd, the reciprocal tariff date remains in full force. So again, we have started to see obviously, investors pay closer and closer attention to this. Yes, they have been able to brush off some of these concerns, but I think it just the ongoing uncertainty coming out of Washington clearly having an impact here on the broader market.
Yeah, and it has a broader implication as well for the Fed policy pathway forward. We've had a range of Fed speakers, Barr kind of kicking off some of the vice chair for supervision, kicking off some of that commentary earlier this week, and getting any inclination right now as to how they're going to continue to react, because that's what it's going to have to be in terms of their data dependency, their reactionary policy decisions that they make and how swiftly they make them if tariffs do impact their own inflation targets as they're trying to tamper that down to 2% as their long run goal here. So that particularly is of interest as well for the markets over the course of this week with the 2 trading sessions today and tomorrow that we do have left, and the Fed speak that has been going forward but hasn't really been the core central and driving force around the markets the same way it was in years past at this point.
All right, let's talk a little bit about Nvidia, because Nvidia beating fourth quarter expectations, revenue surging 78% from a year ago on strong AI demand. Now, the chipmaker also issuing strong guidance for the current quarter. Joining us now, we have Antoine Chikaiban. He is a New Street Research Technology Infrastructure Analyst. Antoine, it's great to have you back here on Yahoo Finance. So we are seeing some gains here ahead of the open. Of course, this comes following the initial drop that we saw on the results yesterday. I'm curious how you're making sense kind of that knee-jerk reaction maybe that we did see and your assessment of the quarter.
Thanks, Shanna. Thanks, Brad, for having me. Great to be back on the show. I would say, our key takeaway here is that Blackwell is ramping very fast. Like 11 billion sales in the quarter. That's well above our expectations. That's well above what the company guided for last quarter of like several billions. And I think that's what the street likes in the print. It means that Hopper revenues are declining overall sequentially. But the most important takeaway here is that it dismisses concerns of a slow, of a backloaded year. There were a lot of concerns in recent months, in recent quarters, around Blackwell being slow to ramp, around like some challenges in ramping the rack level system that's really pushing the boundary of innovation. We're talking about really complex systems here, and I think investors were worried about that. And now you see the company printing 11 billion sales of Blackwell in the quarter. That completely dismisses those concerns, because now we expect in the next quarter probably sales of Blackwell approaching 20 billion revenues. And that's going to more than offset, of course, Hopper coming down. So I would say that's the key takeaway from the quarter here.
And it seems like they're really leaning on these different configurations of Blackwell to drive some of the margins going forward. If we can get real nerdy with it for a second here, what does that configuration set and the broader kind of ecosystem for Blackwell look like here, especially as they're trying to make sure that they can extract more margins to impress investors long term who may not have been impressed on the initial release of the results?
So as you know, up to now, a GPU system, consisted in like 8 GPUs, a GPU server, what NVIDIA has been calling, like a DGX, an HGX, comprised up to 8 GPUs. And as we're moving to Blackwell, we still have the option to have like an 8 GPU server, but now you also have a 36 GPU server. You also have a 72 GPU server. And you can, use different types of networking to connect these 72 GPUs or these 36 GPUs, and you can water cool them, you can air cool them, and so that makes, of course, the ramp of that new generation much harder. And so it's no surprise, that gross margins are coming under pressure, and we expect things to improve throughout the year as the product ramps. But actually, over the longer run, these chips are not getting any less complex. As you think, about Rubin and like its successor, we expect a lot more high bandwidth memory, which is like this memory where the chip can really exchange data with the memory at very, very fast bandwidth, very, very low latency. We expect more of that in the subsequent generations, and that's going to keep driving gross margins down in our view. That being said, revenues are going to grow so much, and NVIDIA is going to be able to extract leverage on OPEX in a way that's still going to drive very, very strong earnings growth. So we're not concerned about any of that.
Antoine, talk to me a little bit more about just the earnings growth that you are expecting in the quarters to come. And I want to play a quick soundbite that we heard from CEO Jensen Huang, NVIDIA CEO Jensen Huang last night, talking about Blackwell Ultra and the impact that he sees that having here in the second half.
Blackwell Ultra is second half. As you know, the first Blackwell was, we had a hiccup that probably cost us a couple of months. We're fully recovered, of course. The team did an amazing job recovering, and all of our supply chain partners and just so many people helped us recover at the speed of light. And so now we've successfully ramped production of Blackwell. But that doesn't stop the next train. The next train is on an annual rhythm, and Blackwell Ultra with new networking, new memories, and of course new processors, and all of that is coming online.
Antoine, I bring up that soundbite there in the context of what you were saying earlier, just in terms of the fact that you thought Jensen Huang was able to alleviate some of those concerns surrounding the delays and maybe the impact that is ultimately initially had on NVIDIA. How strong is NVIDIA's pricing power still here in the quarters to come?
So I think the pricing power is going to remain very strong for the foreseeable future. You don't really have much competition out there that can match NVIDIA. You have AMD that's like more than an order of magnitude smaller today, and who's struggling to ramp more than like its two very large customers, Microsoft and Meta. And then you have ASICs, you have in-house ASICs, and so far you only have one hyperscaler who's successfully ramped, like the TPU, and I'm talking about Google, of course. They've been working on that project for 10 years, and it's no easy task. It's not only like designing the chip, it's also designing all the software on top of that to make a good use of that chip. It's also making a chip that's flexible enough so that it can adapt to all this change, in the workload. That's like all these AI models introduce new technologies from one generation to the next. Now we're talking, about 3 scaling laws. You have like a reinforcement learning that comes into play. All this variation is easily handled by GPUs. It's much harder, when you have like a chip that's more dedicated. And so bottom line is that there isn't that much competition today. And so we expect NVIDIA's pricing power to remain very strong. And if the gross margins come down, it's simply reflecting, first in the near term, of course, the Blackwell ramp, and over the longer run, as I mentioned, like increasing content of memory inside these chips, but nothing to worry about.
Antoine, we only got about 15 seconds. Even with the move here that we're seeing pre-market, NVIDIA will still be down year-to-date scale here. For investors trying to figure out before the opening bell and going into the start of today's trading activity, if it's an investable company at this level on that pullback, what would you tell them?
I would just tell them that we're moving, so 2025, I think is fairly well framed, We have sequential growth that's going to be like in the mid-teens. We expect 200 billion data center revenues for the year. That's consistent with the supply chain on one side. That's consistent with hyperscale capex on the other side. All the hyperscalers have raised capex significantly, and now we have like a consistent view of 25. I think the debate is shifting to 2026. And in 2026, you're going to have a handful of players who are going to move from clusters of hundreds of thousands of chips to maybe 500,000, on a trajectory to 1 million by 2027.
Right.
That's enough to drive all the growth that is going to, be enough for Nvidia to approach, $6 of EPS, and on today's stock price, I think is pretty cheap when you look at this in that perspective.
Antoine, thanks so much for taking the time here with us reacting to Nvidia earnings.
Thanks for having me.
Salesforce issuing a disappointing outlook for the year as its new AI product, dubbed Agentforce, is expected to make only a modest contribution to revenue. Yahoo Finance executive editor Brian Sozzi joins us now with more from his interview with Salesforce CEO Mark Benioff. What did you find?
All right, thanks so much, Brad. Yeah, that is why Salesforce shares are under pressure. On the earnings call, you heard the company talk back the revenue contribution this year from Agentforce. Keep in mind, Salesforce shares ran about 16% higher into this quarter over the past few months, in large part because of that Agentforce optimism. So I asked Mark Benioff, Mark, why did you talk this down? Here's what he said.
Well, of course, we're running a deferred revenue model, and so it takes a while for the revenue to build up. And also, the level of scale that we're delivering, Brian, is incredible. We're not a small company. We're now, as you can see, there's only Microsoft and Oracle have ever delivered revenue above 40 billion. So we're in rarefied air. So it will take a while then for Data Cloud and Agentforce to get up there.
And what I think you're seeing, at least with the notes and the analyst reaction, at least here this morning, and I did a roundup of all these notes on the Yahoo Finance homepage. You can find that there. But some price target cuts on Salesforce after these results. Mostly the street is sticking with Salesforce from either an overweight or buy rating perspective. The thing is, and I tried to put this here on our investor checklist, of course, Agentforce opportunity talked down for this year. It looks like the street is more bullish on this being a larger revenue contribution to Salesforce next year. Now, you can't write off the next 4 quarters or 3 quarters for Salesforce, so they're going to have to deliver on Agentforce, but at least right now the stock could stay in the penalties box, and especially considering where the valuation is following that pre-earnings run-up.
And so it's also just the executive shakeups too, right? That's something that investors are watching too, just in terms of the incoming.
Yeah, that's a good point. So for the first time, Salesforce has combined the CFO and COO role. It's something I'm starting to see other companies do. I mean, it makes a lot of sense. CFO, COO, there's a lot of overlap there in those positions. I think that is in part why you're seeing some of that cautious EPS guidance on Salesforce. It gives the new CFO some air cover, is what I'm hearing, to come out there and build some even more credibility with the street, come out, perhaps beat for the next few quarters, and come out and beat that guidance. So I can't say I'm surprised from that perspective. Anytime you change a CFO, usually guidance could come in below estimates. You have to give that CFO some time to learn the financial statements and come out and put a plan forward of their own.
Certainly, Ariel Saz, great interview. You can check out Saz's full interview with Mark Benioff on yahoofinance.com. All right, well, President Donald Trump isn't slowing down on tariff policy. This morning, announcing an additional potential 10% tariff on China that's set to go into effect on March 4th, and that's along the delayed 25% tariffs on Canada and Mexico. Now, this coming after Trump threatened to impose tariffs on the European Union yesterday. Let's take a listen.
It'll be 25%. Generally speaking, and that'll be on cars and all other things. And European Union is a different case than Canada, different kind of case. They've really taken advantage of us in a different way.
Joining us now to break it all down is our very own Rick Newman. And Rick, I'm curious how you're looking at this, just in terms of how likely they are. I guess it's anyone's guess at this point, and how long we're going to be dealing with these types of threats coming out of Washington.
Oh, I think we're going to be dealing with these types of threats for the duration of Trump's presidency. I don't foresee a time when he's going to be ever completely satisfied with the way we do global trade. Everybody's trying to figure out what to make of this. I mean, the obvious question is how much is bluster and threat and how much is reality. And to some extent, Trump seems to be making it up as he goes along. As part of trying to understand where this all might be going, I went back and looked at the whole timeline for Trump's trade war during his first presidential term, and that was mostly in 2018 and 2019, leading right before COVID. And one unmistakable pattern there is there's a lot of threatening tariffs, and then there's a lot of pulling back on tariffs. So some of them tend to go in place, but not all of them. And I think that's what we're looking at here. So, just for some perspective, I mean, Trump originally, when he was running for president last year, he said he wanted to put a 60% tariff on Chinese imports. And then the first thing he did was, well, he did put tariffs on Chinese imports, but it was only 10%. And now he's threatening another 10%. And I think what he's indicating is that he's not getting the results that he wants from the first threat of tariffs or the actual imposition, which is a decline in the fentanyl shipments. So he's going to keep raising the pressure until he feels like he gets what he wants. Most analysts think that the threats on Canada and Mexico, those would really hit our economy hard, much more than the 10% on China, that he's not going to do that, but that he wants something in exchange. But I mean, everybody who's following this is just guessing. And I don't think Trump himself actually knows.
Yeah, it's sounding more and more like other countries are coming to the realization that the president might want more of the optics of a deal being made, and then the details will be sparse going into it, and we'll see what we get coming out of it as well. Rick, we got to leave things there. We know you'll continue to track this for us. Coming up on Morning Brief, everyone, we count you down to the opening bell on Wall Street. Plus, for earnings coverage ahead from Snowflake to Paramount and more. And we sit down with the CEO of Nutanix to break down their latest results. We've got all that and much more on Morning Brief. Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, let's get a blast from the past up in here to start things off. Shares of eBay trading lower this morning after the company issued sales guidance that came in lower than analysts expected. The CEO of the online resale platform attributed the slowdown in sales to softer demand in Europe. Shares right now are lower by about 8% here and continuing to keep a close tab on shares of eBay as we've been tracking them even over the past 52 weeks. It still has been a broader climb higher that we've been tracking here, even despite this little bit of a pullback here. The shares over the past 52 weeks up 55%. It's been interesting to watch.
Yeah, certainly. They talk about the fact that tariffs adding some of that uncertainty that's influencing consumer purchases as well as sticky inflation. One of the trends that they've noticed there at eBay is just the uptick that we've seen in refurbished products and the fact that they are a little bit cheaper, obviously, when you compare it to some of the new products that are being offered right now. That actually accounts up to 40% of the value of the merchandise sold on the platform. So they are seeing steady growth there. It's something that the CEO noted within this release, and looking ahead, it's one of the trends that maybe are expected as we continue to see, obviously, sticky inflation. That was something that was brought up in the GDP report this morning, and then also the more uncertainty coming out of Washington here over the last hour or so, just in terms of some of the plans here for tariffs and the ultimate impact that could have on prices going forward. So again, consumers are faced with a tough choice. Many of them here turning to eBay. One of the reasons that we're seeing some uptick here in the refurbished products category.
What's the last thing you bought on eBay?
I don't think I've ever bought anything.
Really?
No.
Come on now. No. Even for nostalgia's sake. Yeah, tweet at us, whatever the last thing you bought on eBay. Probably a basketball card, honestly.
Oh, really?
Yeah, I used to be a big collector back in the day. Yeah, we'll talk about it all.
Did you get a good deal on it?
Who knows? I think so.
All right, let's talk Paramount. Paramount Global lower pre-market after the company missed on sales profit estimates in the latest quarter. Revenue for the company's cable TV segment that fell on a year-over-year basis despite streaming service Paramount Plus adding its highest number of subscribers that we've seen in 2 years, nearly doubling analysts' expectations. The company also reportedly pulling back on some DEI initiatives as well. When you take a look at the stock reaction here, off just about 1.5%. You can really see that the focus here, at least from the street, is on the weakness coming out of the TV side of the business, and the fact that that was not solid enough and brought up enough concerns here to overshadowing some of the strength that we've seen in streaming and in movies business. Of course, cost is a big concern here for the street going forward, just in terms of how much is being spent, what is necessary in order to pull back to offset some of the weakness within the TV category. And at least when you take a look initially at the street's reaction, they think that there's a long way to go.
Yes, there is. Total company revenue, that did grow 5% for Q4, not impressing investors there. Paramount Plus, that increased revenue by 16% for the fourth quarter and 33% for the full year, the fiscal year here. And as you think about how all of the companies are kind of using Netflix as their North Star to try and extract even more value in the average revenue per user that they're seeing here, these percentages are kind of far off of what Netflix has been able to have even activist investors call out for some of the names out there in the entertainment, direct-to-consumer entertainment landscape, even like Disney, when there were activist pressures and campaigns there here. So you got to wonder for Paramount in their own ambitions here, how that's going to translate in that long term, in the ramp, especially as, I think out to some of the Deloitte digital media surveys that talk about the number of subscription services that families, that companies, households, not companies, I guess your household is a company if you want to look at it that way. But as you're thinking about the number of subscribers or subscriptions that households are comfortable having right now, that used to be at 3 or 4. Now with all of these price hikes, that's seemingly continued to deteriorate to be 2, maybe 3. Maybe you're borrowing a friend or a family member's subscription and password, and then we've seen the crackdown on password sharing too. So it's going to be a long road ahead, as you mentioned, for Paramount, and a larger question of what type of value extraction they're able to get from the paying customers on the platform.
Yeah, I think the combination with Skydance very much, it comes down to execution in terms of what that looks like, the timeline of that. There's certainly a lot to like in this report and be encouraged about, especially when you take a look at the progress here when it comes to streaming, the solid subscriber gains that the company did have during the quarter while narrowing its losses. So again, there are a lot of things to like here within this report, but I think the overall weakness on the TV side at least outweighing some of that for now.
Yeah, 5.6 million new subscribers on Paramount Plus. That was their best quarter ever. Finally here, let's talk about shares of Snowflake. They are on pace for their best day in 3 months on enthusiasm for its better than expected sales forecast and increased AI offerings. Snowflake expects product revenue to jump by 24% in the current fiscal year here. The company also announcing it will offer its customers direct access to OpenAI through its platform, building on a similar partnership with Anthropic announced last year. Shares of Snowflake, they are jumping by about 13% here pre-market, not too shabby.
Not too shabby. I mean, these numbers are strong. You're taking a look at the strong fourth quarter results. Product revenue was up 28% from just a year ago. You mentioned the fact that the company guided here to fiscal 2026 product growth. That was actually at 24%, which is just above the street's expectations. So they did deliver on the strong results here for the most recent quarter. Taking a look at the guidance, the outlook obviously very bullish. That's why we're seeing the size of the reaction here in the share price here this morning. I think the question is whether or not some of that momentum can continue, given the fact that that revenue growth is beginning to stabilize here in the mid 20%. Whether or not they can continue to do that, expand margins, is a big question here from the street.
Yeah, that got brought up on the call too here, especially thinking about the growth in this environment. And one of the analysts here had brought up on the call, the software companies right now, there are not many of them that are actually growing at scale and growing 30% in this environment. And one of the huge things that this comes back to is both the existing customers that a company like Snowflake has, but the net new customers that they're also bringing on board. And if you think about those existing customers and how they're selling further into that base, renewing and renewals among those customers are going to be core. The company talked about that and fully expecting that many of those existing customers would sign new commitments to really kind of lock in that baseline rate.
All right, well, keep it right here on Yahoo Finance. We are just getting started. Opening bell coming up next.
There you're taking a look at the opening bell at the NASDAQ and on Wall Street at the New York Stock Exchange. You've got Aitco ringing the opening bell. Yeah, press it, young fella. There we go. He pressed the button. He got some funfetti. And then you've got Primo Brands ringing the opening bell at the NYSE. If you've had water, you've probably had a Primo brand, honestly. Parent company of Saratoga, companies like Poland Spring underneath of its belt as well, plus about a dozen plus maybe 24 others as well. All right, taking a look at how we kick off today's trading activity. The Dow Jones Industrial Average, you're seeing things start off the day higher by about 0.1%. We'd love to give you some context here, so I'll put this on a 2-day view here for you. And ultimately, over the past 2 days, still net lower by about 0.3%. Let's give you a 4-day and show you what's transpired this week. And that's where you see some of that waffling taking place here over the course of this trading week. Also, the NASDAQ composite, you're seeing that open up higher here by about 0.75%. Past 4 days, not great. It's down by about 1.5%. We'll see what we can do about that today. S&P 500, you're seeing that to the upside by about 0.5% to start off today's trading activity. However, over the past 4 days, 4 sessions, lower by about 0.5% at this juncture. Let's take a look, since we mentioned the S&P 500, at the 11 sectors of the S&P 500 to kick off today's trading activity. Looks like you've got more advancers than decliners right now, 6 in the green to the 5 in the red as of this juncture. Utilities pulling up the caboose right now. That starts off the day down by about 0.7%. We'll round that off too. However, communication services, wow, up by 0.9%. And since we're talking about some of the heat map activity, let's go on over to the NASDAQ 100 heat map, where we've got to look at Nvidia just to see how things kick off on this trading day. After those earnings that came out yesterday after the closing bell, we begin today's trading activity higher by about 1.2%. But let's give you the broader context here. Year to date, it is still ultimately lower despite this move higher to start off today's trading activity. And if you've seen some of the volatility that has transpired in one of the earnings bellwethers that is out there for the semiconductor, the AI trade, and more broadly, all trades for the past year and change here. For more, let's get on over to Yahoo Finance's Jared Blickery for a look at what's moving here early in today's tape. Jared?
Well, thank you, Brad. Thought we'd take a look at the month that almost was with the NASDAQ composite, because it is down 1.5% in these 4 days. But let me put the 18-day total here, down 2.07%. That's bad enough to actually make it the worst month since April of 24. So that's last year, almost 1 year. But still, not that bad. And if you take a look at the NASDAQ 100, I think it's instructive that is down not even 1%. So the larger cap-oriented NASDAQ 100 also down, but not quite as much, and not with that comp that we were looking at with the composite. Just going to take a quick look at the 10-year T-note yield. That is up 4 basis points today. And the U.S. dollar index also jumping, but nothing to write home about. So we're going to move on to the sector action. And much like our last analysis, I just want to point out, first of all, actually, that consumer discretionary, one of the leaders today, as Staples is one of the biggest laggards. And that's kind of how the month has gone. Here we're going to do a month to date over these 18 trading days. We're in the 18th right now. Staples, that's XLP, that is in the forefront. And consumer discretionary, that is an Amazon and Tesla story, that is pulling up the rear there. That's down 6.6%. Moving on, let's take a look at the Mag 7 real quick. As Brad was just noting, only Apple of the Mag 7 is down, and that's just by a smidge, about 12 basis points there. Nvidia up about 0.6% after that much anticipated earnings report there. And there, Apple just turned green. So what do you know? Want to focus on ARK for a second. The ARK Innovation Fund, and that's the ETF that houses all this, actually having its worst month since April of 2024 last year. And you'll remember that is also the stat that we had for the NASDAQ. Here is month to date, and you can see Tesla, the biggest weight there, down 27%. Coinbase also down 24%. And if I got a little time here, going to tell you real quickly that in futures, WTI crude oil is jumping the most in 6 weeks, but I want to get to Bitcoin. I'm going to leave on that. We touched 82,000 overnight or yesterday, and we are bouncing up. But Bitcoin itself on track for its worst month since November of 2022. That wasn't the best year for crypto, but that was close to a bottom. So we'll see what happens with crypto here today. Shauna?
All right, we'll be watching. Jared, thanks so much. It's time now for today's strategy session. The S&P 500 has been stuck in a narrow trading range, with the benchmark index not entering oversold or overbought territory since July. However, our next guest warning of a potential 10% correction looming. We want to bring in Barry Bannister, Stifel Chief Equity Strategist. Barry, it's great to see you. We are looking at Nvidia offering maybe some relief to the markets here this morning, but it doesn't sound like you think it's going to last. Why?
Well, the market lives for easy interest rates. We do think the Fed will cut to 4.0% mid-year, but there could be a hawkish hold. In other words, with inflation stuck closer to 2.75% on what's called the core PCE deflator, the number that the Fed watches very closely, it's very hard to justify too many cuts. I mean, if you look at the real interest rate, the rate after inflation, the middle value, the median, the last 50 years, short-term money should give you 1.21%. And so if you're looking at about 2.75 to 2.8, add 1.21%, you see how the Fed really can't go below 4. So as we get through the year, I think the Fed will probably take back or react slowly to a slowing economy. that second rate cut.
What are the top factors that you think would drive that activity from the Fed?
Well, the stickiness of inflation and the economy decelerating then brings the question of what is the Fed's reaction. It's called the reaction function. I think the Fed will be a little slower. Stagflation, even mild stagflation, which is a little more stagnant economy and sticky inflation, could cause a pullback in the consumers. They'll decelerate from the recent 4% spending rate. And jobs are becoming a little harder to find. And they have spent themselves up quite a bit. We wouldn't be surprised to see the consumers pull back. You're not going to get anything from government or net exports with the strong dollar. So the GDP numbers will really fall off as you get into the back half of the year. And again, the Fed's reaction to that, with inflation still very sticky, is going to be the tell.
Barry, I'm curious how you're looking at the moves that we've seen in the bond market. You have the 10-year yield right around 4.3, substantially lower than that 4.5 range that we were trading around now for quite some time. What does that signal to you, just in terms of what is being priced in, and ultimately how this will likely play out for equities?
Okay, let's say, like I said, the appropriate short-term rate is about 4. Now they can go easier than that, and we have had, Jay Powell has been, believe it or not, one of the more easy Fed chairs of the last 3. I mean, Greenspan in the back half of the 90s in the tech bubble had a much higher real interest rate, or a rate after inflation. And Bernanke in 2005, 6 into 7 actually got to a much higher real interest rate. So Powell is an easy peasy chair, no question in my mind. And when you had the long end, so you've got the short end around 4 is a fair value. The long end was 4.8. Markets felt that. They went sideways. It pulled back to 4.3. That 50 basis point drop in the 10-year yield has really been keeping us from dropping. And the question then becomes, economy decelerates, inflation sticky, what's the Fed going to do? How does the bond market react? And this is all going to play out over the year.
And so then on the equity side of the trade, what is the defensive play that investors could orchestrate with their portfolio right now?
Well, ever since the Nvidia quarter 2 years ago, everyone's been on the AI trade. And I understand, keeping a position, even I do, keep a position barbelled into tech to benefit from the mania that we're in. But you're at a very, very high multiple of earnings. Your more sophisticated valuation methods like enterprise value based against economic profit or return on capital above cost of capital, they also indicate, very much like the late 1990s, a level of enthusiasm among investors that it's dangerous. So what you do is you barbell that, or you are defensive against that with things like healthcare, staples, utilities, which are not doing well today. So you buy on the dip.
And so if you are dip buying, are those the top dip buying opportunities, those that are on the defensive barbell or side of the barbell? Or is it some of the riskier assets that might also be seeing a significant pullback here and have already kind of run high on valuation?
Well, like I said, the first 6, maybe 9 months of the year will probably end up being in a trading range. And it has been year to date a trading range. But then you'll have a sharp fallback, particularly your late third, early fourth quarter, typical almost seasonal weakness in the stock market. So it could be just a very wobbly year with a pullback in the market that would benefit defensives because they would hold their value. Their price earnings multiples, by and large, are not as bad, and their earnings are decent. So in a sense, they would just be defense against a more offensive strategy that is really fully valued here.
All right, Barry, always great to talk to you. Thanks so much for joining us here this morning. Barry Bannister of Stifel. It's time now for our chart of the day. Let's send it over to Madison Mills for a closer look at stock picking. Maddie.
That's right, Shauna. Stock picking is so back this year. If you take a look at actively managed funds, you can see that nearly half of them have outperformed funds that just track the S&P 500 year to date. And if you take a look historically, that's not necessarily the case, right? We always say that, especially for retail investors that don't necessarily have a lot of great hygiene, you're in luck because it's actually really hard to outperform the S&P 500. If you look at the past decade, you can see here behind me that actively managed funds have struggled to outperform the S&P. It's usually typically about 10% of them that can eke out gains better than the S&P 500. So what does this tell us? Well, this is another example of those mega cap tech names not being the performers that they once were and that we've grown accustomed to, especially over the last 2 years. That Magnificent 7 ETF is still in correction territory, and that is good news for these active managers who are looking to have an edge on the market, and therefore they are not necessarily invested in a market cap weighted structure like the S&P 500. So again, this does present opportunity for active managers who on average do tend to struggle to outperform those major averages here. It's all about kind of finding which companies now can sustain earnings momentum, especially as more broadly within those tech names we're seeing earnings moving sideways just a bit here. So we're going to continue to talk with investors, and I think hopefully this leads to more interesting conversations with them about how they are navigating this tricky environment and finding opportunities for that earnings momentum when you can't just rely on the big tech names.
Maddie, thanks so much. Appreciate it. Coming up, everyone, a beat and raise quarter for software infrastructure company Nutanix. We'll discuss the latest results with the CEO. You see him there waving. Rajiv, we'll get to you in a second.
Shares of Nutanix, the infrastructure software company, moving today on the heels of its results. You're looking at gains right now of nearly 10%. The company boosted its revenue guidance for the full year after beating the street's adjusted earnings expectations for its fiscal second quarter. We want to bring in Rajiv Ramaswamy. He's CEO of Nutanix, joining us now. Rajiv, it's great to have you back here on Yahoo Finance. Talk to us about the quarter. Clearly, you are seeing a lot of momentum that's reflected in the guidance, just in terms of some of that carried over momentum that you're expected to see in the quarters to come. Talk to us about the biggest driving factor here of that.
Shauna, great to be with you all today. Three factors are driving our results and our guide as well. The first is that companies and organizations around the world are choosing Nutanix because we deliver a platform that can help them run all their modern applications in a very efficient way, while also enabling them to do things in the future with AI, generative AI, and other new workloads that might come up. The second is that there's a number of customers and organizations around the world looking to reduce their dependence on one of our competitors, VMware, now owned by Broadcom. And Nutanix is the best platform and the easiest platform for them to migrate those VMware applications over. The third is we've been working on our go-to-market efforts for quite a while now, and we're seeing the fruition of some of that now across our customers, across our partners, across our own sales go-to-market engine. And we're seeing some increased contribution from some of our OEM strategic partners as well. So all of this has contributed to these results that you saw in Q2 for us, and also contributed to our ability to raise the guide for the full fiscal year.
For B2B companies, Rajiv, for a few of the past quarters, we've heard about these elongated deal cycles. Where does that stand right now as you've been working with both net new customers and existing customers and trying to drive renewals there?
Yes, and Brad, that's a great one. I mean, we've been talking for several quarters about this as well. The fact is that deal cycles have been somewhat elongated. They need more approvals. People are more careful about making sure they get the return on whatever investments they're making. And again, as a platform, we deliver significant total cost of ownership benefits. Now, you can see the results of some of this coming. Our new logo count has been growing up about 50% year over year, this quarter as well as in the past quarter. So we continue to see more and more customers embracing our platform. And that's, again, a testimonial to the fact that we are able to deliver those benefits to them.
Rajiv, are you seeing any signs of tighter budgets there from your customers?
Well, the macro piece of this has continued to remain fairly stable. It's still uncertain, it's dynamic, lots of potential changes, but we've seen a fair amount of stability. There's still a lot of scrutiny into what they spend their money on, but we feel good about the pipeline that we have in front of us, and that's really what has enabled us to raise our guide for the full year, despite what's going on around us.
What are you seeing in cybersecurity as a driver for some of the discussions that you're having with potential customers or existing customers, and how that's also flowing through to the deals that you are seeing come through?
Yeah, I think security is an integral part of what is top of mind for almost every customer. For example, I mean, when we look at our product, we provide things like ransomware protection that's built into our platform. We provide strong encryption. So security is an integral factor as they consider any of these enterprise class platforms. Companies are running their business critical applications on a platform like ours, and they want to make sure things are secure. And we have a number of capabilities in there to help them with that. And also potentially simplify their security posture and make them be able to be more defensive against attackers.
When you talk to me a little bit more, Rajiv, because what you're saying about the macroeconomic backdrop is very interesting. And I'm curious just in terms of how that's influencing or impacting how you navigate your strategy here in the coming quarters. And also just a sense from a business leader of some of that uncertainty coming out of Washington. How are you then unpacking that and trying to figure out the best path forward?
Yeah, I think, again, this is a very dynamic environment. Things are changing every day. We don't control a lot of that, but we have to adapt to what's going on. There are a number of factors in there. There's talks of tariffs, and we as a software company are a step removed from that. But we try and provide, for example, a lot of flexibility to our customers to be able to run on a variety of different hardware. And our hardware partners, for example, are doing everything they can to diversify their supply chain and be able to manage potential impact of tariffs. But we are a step removed from there. We do business around the world, and we continue to serve those customers around the world. Europe, for example. But net, I would say we are focused on what we can control, and we will adapt to whatever new policies come up and adapt to that. Again, I think we still feel good about the outlook despite what's going on in the macro, given the factors that we've talked about earlier. And that's why we're raising our guide.
Just as a follow-up to that, I guess the kind of consideration, and I think this came up on the call too, with regard to government spending that we're seeing at this junction. Yeah. I think you have some government partners that you work with as well. Are you seeing any contraction in the propensity to spend from them, knowing that there are these cost-cutting measures that are being rolled out?
And that's an interesting dynamic. I'll say, first of all, that the US federal government over the last 3 years has represented at most 10% of our overall revenue. So our exposure is a bit contained there. But that said, we work with a lot of arms of the federal government across defense, civilian, intel, et cetera. And our pipeline is good, right? And interestingly, I mean, we don't know how much of that will be impacted by what's going on here. But also, our technology can be a key enabler to make government organizations more productive, more efficient. So in some ways, I mean, as organizations will invest in technology to make them more efficient as well. So there's puts and takes on this, and we factored this in as we provided our increased guide that you're seeing there.
Rajiv, always a pleasure to grab some time with you. Thanks so much for breaking down the most recent results.
Thank you, Brad. Glad to be with you.
We've got all your markets action straight ahead. Stay tuned. You're watching The Morning Brief. We're taking a closer look at some trending tickers this morning, and we're doing it in 30 seconds each. Let's go. First up, British energy giant BP reportedly under pressure increasing right now from activist investor and Elliott Management around its turnaround plans here. BP announcing Wednesday it will turn focus back to its core oil and gas business while lowering spending on renewables. According to a Bloomberg report, Elliott sees the plan as lacking in urgency and ambition and thinks it didn't go far enough. Bloomberg reports Elliott has a nearly 5% stake in the energy company.
Plus, Nissan Motor is making plans to replace its CEO. That's according to a report out from Bloomberg. Now, the company's directors are gauging interest in potential candidates to replace the CEO, who has been with the company for 22 years and CEO since late 2019. Now, this comes after the Japanese automaker cut its full-year outlook for the third time, and merger talks with the rival Honda have collapsed. Now, Nissan has struggled to boost demand for its vehicles, relying on promotions to keep control of its inventory.
Finally, Norwegian Cruise Line is signaling strong cruise demand this year. Even as its profit outlook missed estimates, they see full-year adjusted earnings per share at $2.05 versus the projection for $2.09. But the cruise line says their outlook establishes a clear path towards their 2026 targets. Norwegian says they remain at their optimal booked position for the next year. The company also beating profit expectations in the fourth quarter. Shares, though, down 5.5%.
All right, well, that does it for Morning Brief. But keep it right here. Catalyst is coming up next. Welcome to Catalyst. I'm Shauna Smith alongside Madison Mills. 30 minutes into the U.S. trading day. Let's get you the three catalysts that we're watching this hour.
First up, we'll break down Nvidia's earnings and what it means for the artificial intelligence trade.
Plus, is the agentic AI trade gathering steam? Salesforce earnings not looking like a strong indicator.
And Tesla wiping out its post-election gains, dropping below $1 trillion in market cap. More details ahead.
Let's take a look at the move that we're seeing in the broader market here, just about 30 minutes into the trading day. You're looking at gains here, at least for the Dow, still holding on to that movement to the upside, looking at a rise of just about 0.2%. But you do have the S&P and the NASDAQ now in negative territory. You look at the tech-heavy NASDAQ off just about 1.3%. Some of the selling across some of those larger cap tech names. Nvidia out with its results last night. We initially saw some buying activity, some optimism here ahead of the opening bell, right at the open. Right now, though, we are looking at losses of just about 3.5% in Nvidia. That, of course, is also being reflected in some of its competitors right now, as you do see some pressure across some of those other larger chip names. Taking a look at the bond market, we know lots of activity we have seen there. We are seeing a bit of a move to the upside here, but still, you're looking at the 10-year yield right below that 4.3 level at 4.29. Let's talk about Nvidia, because Nvidia shares are moving to the downside. Other chip names are doing that in tandem as well, following another quarter here for the multi-trillion-dollar chip maker. While CEO Jensen Huang did tout strong demand for Nvidia's Blackwell chip, analysts are raising some concerns about the company's gross margins outlook, citing some pricing pressure and potential for fierce competition as headwinds. So how should investors be thinking about the future of AI? We want to bring in Paul Meeks. He's the Chief Investment Officer at Harvest Portfolio Management. We also have Sinan Aral. He's a professor at MIT. It's great to have both of you. Paul, let me just go to you first here, because we're looking at losses right now, just about 3.5%. Very different than some of the movement that we saw here this morning. I'm curious, just help us make sense of some of that selling action that we're now seeing.
So I think the quarter was pretty strong. I don't think any near-term gross margin pressure comes from pricing or from competitive threat. It comes from the natural manufacturing ramp of the Blackwell chip. And I would say that the guidance that they gave for 71% gross margin, which is still pretty impressive for any American company or any company anywhere, but it is down from 75%. I don't think that they could give us a confirmation that 71% in the April quarter, this quarter, was going to be the trough. So that's a little bit of a disappointment. But I think a lot of the action today is just more anxiety about the world of Trump tariffs. Overall, I think this company will, in the second half of this fiscal year, continue to reaccelerate sequential revenues, particularly in the data center business, which is 91% of their total revenue pie. And so I'm very confident.
So, Paul, just to put a button on it before we move on, the degree of selling we're seeing, Nvidia hovering around losses of about 4% right now, you would attribute that to President Trump reaffirming those tariffs on Mexico and then adding an additional 10% tariff on China?
Yes, I think that is a factor that even when Nvidia gave their guidance, couldn't incorporate, right? It's unfortunately, it's an unknown. But then the other worry, as I said, about Nvidia is a fear that this quarter's gross margin at 71% will not be the trough. So I think those are the only flies in the ointment. One is geopolitical macro. I can't control that. I feel very good about the Blackwell ramp. And so I think it's going to be a trade today, mostly on the macro, that are going to take things to the downside. And it's essentially a risk-off trade today.
So now I'm curious how you're looking at the results that we got last night, in particular some of the guidance that we did get from Nvidia, just in terms of that strong demand. They don't see that stopping anytime soon. What does that tell you just in terms of where the focus then should be for investors as we talk about that next phase of AI adoption?
Sean and Madison, thank you for having me. It's good to see you both. NVIDIA had a reality check with DeepSeek. Everyone was talking about whether this was the end of large data compute. But those of us in the know that this is in no way a real threat to the demand for compute. As efficiency gains like DeepSeek are found in training, you move to needs for compute in other areas of AI like inference. And in fact, efficiency gains allow widespread adoption of the technology because it becomes more cost-effective, easier to adopt. As that widespread adoption happens, there's more demand for compute, more demand for NVIDIA's chips. This is sometimes called Jevons paradox, which Satya Nadella talked about actually recently. Also, the models are getting more complex. The hardware is getting more complex. This is creating the profit margin pressure that Paul talked about, but it's also creating demand for compute. Because as we move from more basic language models to reasoning models, they require more compute and more demand for these types of chips. And finally, the agentic age, which I think you're going to talk about a little later on, we're moving from AI that simply gives advice or guidance through language to AI that can make decisions and actually take actions in the world. And as we move to this more complex environment, the demand for compute is only going to continue to grow. Demand for data centers, demand for chips, only going to continue to grow. I would say one thing, which is the thing that investors and companies like NVIDIA need to think about, are potential paradigm shifts in the paradigm. So there I'm talking about quantum, there I'm talking about photonics. Obviously, we had a major announcement from Microsoft in the Moderna chip that they put out. These types of things could change the game.
Paul, I want to go back to you here because this conversation is happening in the context of the Mag 7 ETF being in correction territory, down 10%. Given the reaction we're seeing right now playing out in Nvidia stock, again, still experiencing some pressure this morning, does that change your investment thesis when it comes to market cap weighted investing versus an equal weight investment approach?
Well, we've definitely seen a broadening out of the market, where for a long, long time, the market cap weighted S&P was crushing the equal weighted, but now we've seen, both are in sync, and actually the equal weighted, at least 2025 to date, is outperforming. So yeah, I think it deserves to be a broadening of the market. I'm not a problem with that. As it pertains to the Mag 7, for the longest time, particularly as I play this AI theme, I have only been interested in Meta, Amazon, and Nvidia. I've actually been away from some of those other stocks for some time.
Paul, when you take a look at, I guess, the opportunity then, more broadly speaking, given just the uncertainty coming out of Washington, given this whipsaw effect, given the fact that so much of this AI momentum story has hinged on NVIDIA specifically, it doesn't sound like you've heard anything in the call last night or anything in these results that necessarily change that investment thesis, right?
No, and remember, I'm saying that the key culprit among their financials that they reported and guided to, gross margin going from mid-70s down to low 70s, I don't think it has to do with pricing. I don't think it has to do with DeepSeek or any other threat. It is the manufacturing ramp and an underutilized fab. And so as that chip, the Blackwell, ramps, the gross margin will come back. And I think by the end of this fiscal year, which ends January 31, 2026, that the gross margin will be back in the mid-70s. So I'm comfortable.
And Sinan, to go back to you here, you mentioned a little bit about quantum computing, and obviously Microsoft had a quantum announcement with the Moderna chip. We also had an announcement from AWS on a quantum computing chip. Is that a potential headwind to NVIDIA in your view?
It depends on how quantum plays out. Obviously, it is a different paradigm for hardware. It's a different paradigm for chips. But let's not forget that NVIDIA is also investing deeply in quantum. And so we'll have to wait and see to understand which companies win there. That is not a short-term reality. That is something that investors need to continue to look at long-term and understand where each of these companies plays in terms of its strengths and weaknesses in quantum. That is one of those events where as we see quantum develop, it could change the nature of the chips and therefore change the paradigm. But all of these companies are investing deeply in that possibility.
All right, Sinan and Paul, thanks so much for joining us here to break it all down. We really appreciate it.
Thank you.
Thank you.
Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of this session. You can do that all at Yahoo Finance's trending tickers page. First up, let's take a look at shares of Vistra Energy. You're actually looking at losses of just about 4.5%. They're pulling back from some of the earlier gains that we initially saw. Now the energy company beating fourth quarter earnings expectations, reiterating its full year guidance. Vistra was one of the top performing stocks in the S&P last year, expected to benefit from the increased energy demand from AI data centers. And Maddie, when you take a look at the move today, at least to me, digging through this report and maybe the initial reaction, not so much a fundamental concern that's really driving maybe the share price action today, but you have to remember, and like we just said, this was a massive outperformer last year. We saw a huge run up in the stock. A lot of that could be just of a give back here to the fact that guidance wasn't even stronger than initially stated. I think that could be one of the drivers here that we are seeing to the downside. But again, you're looking at shares still able to hold above that 141 level.
It's really interesting. As you were talking, Sean, I was pulling up a chart just to take a look at the action today, because we saw this share price hitting as high as 152 earlier. Now we're seeing a decline, perhaps a bit in sympathy with a bunch of the other chips names that are also under pressure. But to your point, of course, there was some weakness under the hood of the print. It was interesting, though, to see a little bit of a turnaround story here, too. Last year, they lost $184 million. Now they're reporting net income of $490 million. They've got those 3 nuclear plants that are diversifying them as sort of this nuclear play. They are the second largest owner of nuclear beyond Constellation Energy, which is, of course, the first largest owner of nuclear plants. But again, it's been interesting to see kind of these diversified energy plays and utility and nuclear plays like a Constellation and a Vistra getting so much attention in 2024, and a little of that coming under pressure. And interesting to just see the movement in tech names today in general, I think weighing on the broader averages as well. Next up, Warner Brothers Discover shares surging as big expectations for its streaming growth offset a slight miss on revenue. The media giant added over 6 million subscribers to its flagship Max streaming service in the fourth quarter, bringing it to a total of nearly 117 million subscribers. The company is saying it expects to reach 15 million by 2026, driven by White Lotus viewership, I'm sure. But you've got nearly 6% gains on the stock right now. I'm going to point out some things that our entertainment reporter Ali Canal sent over to us. She said the subscriber guidance was probably the biggest catalyst for the moves here. Also, she noted the adjusted EBITDA coming in higher than expected and said she thinks earnings might have been above from the commentary that she is reading. But she also pointed out the slight miss in revenue as something to keep in mind.
Yeah, and what's interesting is just the discounting that we're seeing of that. It doesn't look like that's a focus at all here from the street. Very much more the focus on that optimism and some of the momentum and strength that we are starting to see within the streaming side of the business. And that really does seem to be the focus, and why we are looking at a gain of just about 6%. When you take a look, that's a 5-day move. When you take a look at a longer term chart here of the company, you can see there has been a lot of uncertainty baked in up until this point, just in terms of what that path forward looks like for Warner Brothers Discovery, how, I guess, to what extent they're going to be able to compete with some of the strongest competition within this space. But when you take a look at these guidance, or when you take a look at the subscriber numbers that we did get here for the most recent quarter, when you take a look at the 150 million subscribers by 2026, really just highlights some of that expected momentum that they continue or expect to see here in the quarters to come. And I think that's really driving much of that excitement that we're seeing play out on the street.
Absolutely.
All right, we'll keep it right here on Yahoo Finance. Coming up next, it's Salesforce seeing slower adoption for its Agentforce platform. We're going to break down the company's results. That's next.
Salesforce issuing a weaker than expected fiscal year revenue forecast hit by slower adoption of its Agentforce platform. That new AI tool is expected to make only a modest contribution to revenue. Joining us now, we've got Brent Bracelin, Piper Sandler Equity Research Analyst, Cloud Software and Analytics. Brent, great to have you here. You got a slight price target revision down to $400 from $405, so very slight there on Salesforce. Does Salesforce have an AI problem?
Actually, no. I think you're having a little indigestion today with what looks like a very tepid guide for Q1 and the full year. But if you put the AI opportunity in context, we estimate the data AI business grew over 30% sequentially. That's an acceleration on a sequential basis. Year over year, they talked about 90% growth in their data cloud business. The data cloud and AI business now is talking 120% growth. So that's an acceleration. I think the disappointment is squarely centered really around tepid guidance. I will remind you that you do have a new CFO here, new COO. Not uncommon for companies to guide conservatively when you have new leadership. I actually think this is a great opportunity here. And they sound very bullish around the opportunity around Agentforce, around AI, and we're quite bullish around the AI opportunity in software. Recall, we spent the last 2 years building out this AI infrastructure, buying GPUs, building clusters of GPUs to drive these foundational models. We're in the top of the first inning here relative to AI having an impact on the software layer, and it's starting to happen. You're starting to see it. It's slow, but it's starting to happen.
But what does that quote unquote more meaningful contribution then potentially look like? If we are seeing a bit of a conservative guidance, what do you think maybe that more realistically could look like in the quarters to come?
I think one small example that Benioff gave on the call last night was a $20 million contract where one large customer contracted $7 million of the $20 million contract to Agentforce. So that hints at how meaningful Agentforce and agents can be as a revenue driver for Salesforce. So I think you have early signs. I know investors want to see a real monetization out of the gate. It is happening. Tripling number of paid Agentforce customers in just basically from December to January. So really good momentum here. It's just going to take time. AI monetization is going to happen differently in applications than it happened in the infrastructure side. So be patient. The good news is the multiples in software have come in for 3 years. And so now you're looking at the opportunity to invest in an AI beneficiary that will take time, but at a much lower multiple.
I also want to talk to you about Microsoft, the company urging President Trump to ease the limits on chips that can be used in data centers for training these AI models. Talk to me about your outlook for Microsoft when it comes to their ability to withstand any potential headwinds from tariffs and any headwinds that could come from entering into a back and forth with this administration.
Sure. I mean, Microsoft obviously is also seeing early stage benefits of AI in the app layer. You're now talking about a $10 billion plus business growing triple digits as well. They were a first mover here around AI. And what they're really, I think, trying to do here is try to prevent and limit the amount of regulation the government is doing here and stepping up to try to potentially slow adoption. So obviously, export rules are one of those regulatory governors that could limit adoption. Obviously, in an ideal world, you wouldn't have government stepping in, a policy stepping in here and slowing adoption. But again, I would point to the early tea leaves on Salesforce, the numbers we saw out of Microsoft around Microsoft's AI business, and even Snowflake last night as further evidence saying AI is starting to show up in the application layer in these software names.
I guess, Brent, how should investors then be factoring in the uncertainty coming out of Washington, just in terms of the ability or potential that it could handicap some of that upside momentum that we've seen?
You're seeing that now, right? Microsoft's down 5% year to date, 15% below the high. Salesforce is down 11% year to date here based on the sell-off this morning. So you're seeing very tepid guidance out of these companies for the year. I think that sets up where we're baking in the risk around government potential delays and dodge efficiencies and a slowdown in orders in that world, baking in some of the risks around FX uncertainty. Currency is actually now starting to be less of a headwind based on what we've seen over the last few days here. So I actually like the setup on software because the multiples now bake in some of the risk around regulatory change, policy change. It's been an overhang on the group, could remain an overhang for the next quarter or two. But again, we feel like in 3 quarters, you're going to see AI momentum start to build here and start to drive a change in the growth trajectory of this business. You're going to see it first at Snowflake. They're actually guiding to an acceleration in growth. I think that could happen at Salesforce later in the year as well.
I want to end by talking to you about Snowflake. Huge jump this morning, up 13% in their biggest gain since November. Coming off of that just a bit here. What is your base case for Snowflake?
Yeah, a bit of a broken record here for me. Talking about AI coming to the application layer, coming to the software layer. Snowflake, for the first time in 3 years, is guiding their product growth to essentially accelerate into the second half, exiting Q1 here. So base case scenario, $4 billion business. This is a data software layer. The first area people are going to spend, large enterprises are going to spend, is cleaning up their data estate. That's essentially what Snowflake's really good at. Sridhar, new CEO, stepping in here, essentially scaled the ad business at Google to a $100 billion business. He's now leading the charge at Snowflake. You're now anniversarying his first year at the helm, and you're starting to see a very tight focus on product execution, 400 new features they've added in the last year. Now they're going to focus on taking some additional scrutiny on go-to-market and really putting more pressure on those sales efforts to try to sell all these new products that they've come up with. The change for them, what's driving the acceleration in growth is AI. They have added 6, 7 new products specifically aimed at driving and attracting more AI workloads onto the Snowflake platform. That is now starting to happen.
All right, Bratton, great to talk to you. Thanks so much for breaking it all down for us. Really appreciate it.
You bet. Thank you.
Coming up, we're going to take a look at why shares of Moderna are under pressure after the White House's latest decision on vaccines. We'll be right back. Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, let's take a look at Moderna. Shares are ticking lower, off just about 5% right now, following reports that the Health and Human Services Department is reviewing a contract with the drug maker to develop a bird flu vaccine. Joining us now to break it all down, Yahoo Finance senior healthcare reporter Anjali Kimlani. Anj.
That's right, Jana. I mean, the news for Moderna couldn't come at a worse time. The company is already looking at declines from the COVID vaccine, as well as just a slower respiratory season compared to the last several years. So the company now, with this potential review of a contract for a bird flu candidate, was supposed to be taking that candidate into later stage trials, and whether or not the U.S. government continues to fund that could weigh on the company's year. We know that they already reduced basically the outlook, the forecast for the year between 1.5 to 2.5 billion for revenues for the year, and that's down from 3.1 billion in just the Spikevax sales alone from last year. So just to give you an idea of what that looks like. Meanwhile, taking a look at just the numbers for that contract, the contract itself looking at about $500 million alone for that. And then that translates into what the outlook is also for other vaccine makers, though we haven't seen as much an impact on those stocks just yet. But it is interesting to see how the new administration is handling the threat of bird flu, which we have seen take a few lives, though it has been rare cases, and definitely affecting the animal population. So we'll see how that goes.
Yeah, can we talk a little bit more about that? The Trump administration cutting funding specifically for the bird flu. Can you update us on where the administration stands on its contracts with some of these?
Yeah, it is looking at a couple of others. So Vaxart is another company that it was looking at. We've also seen it take a hard look at just generally how it's treating vaccine makers, specifically for flu. The FDA just canceled a meeting that was supposed to take a look at and pick the strain necessary for the upcoming year. And this is around the time when vaccine makers need, sort of a heads up on how to manufacture and what strains to produce to see what's circulating. So it's not a perfect science, but it has been a tradition for so many years. And that's something that we are in a bit of a loophole right now for that. So we'll see how it goes.
And you've got a lot of coverage here today. So Novavax also, I know, is on your radar. We're looking at shares up just about 9%. Earnings helping to maybe alleviate some of the concern that we've seen plaguing the stock.
Yeah, Novavax, especially because the company has sort of given investors a look at something that I guess they've been asking for some time. Lots of concerns for a company like Novavax, which is a single product that to the COVID vaccine, which we just talked about on the decline. And in addition to that, a company that hasn't had anything else really coming out of the pipeline and has struggled to really set itself apart. Unlike the way that Moderna sort of took off with the government funding during the pandemic, Novavax hit a few stumbling blocks, and there have been questions about its viability. It has warned a number of times that it may not continue or have enough cash on hand ongoing, but now we're looking at a shift in the way that the company is operating today with earnings, talking about being more of a drug technology platform and licensing that out rather than being a product company and investing in clinical trials and the like. So it handed over the reins of commercializing its COVID vaccine to Sanofi last year. And so this is the first full year that that's going to take effect. It is not yet an approved vaccine. It still stayed in authorized territory. And so that is something that Sanofi can take over. Meanwhile, moving into that drug category is going to be an interesting one for the company and its finances. Right now, looking at the numbers, $682 million for the full year for 2024, and that's compared to 682 for the full year, 291 million for the year prior. So did a bit better than expected. The quarter over quarter was also a bit of a miss. So we're looking at that sort of trend continuing. Despite that, the company stock is up because, again, giving investors what they're looking for, which is a little bit more stability, a little bit more focus on what the company can do rather than just focus on spending a lot on making more products.
All right, Anj, thanks so much for breaking all of that news down for us. We appreciate it. Another trending ticker we're watching, Palantir, once again in the red. The company breaking its 5-day losing streak on Wednesday. Palantir stock having its worst 3-day streak since 2022 after news that the Trump administration was eyeing cuts to its U.S. defense spending to the tune of about 8%. The stock hovering around the flat line right now, down about 0.2%. But when I checked earlier this morning, it was moving to the upside by about 2.5%. And it was the second biggest mover based on volume and trading activity, just under Nvidia. So certainly getting a lot of momentum on the stock as the AI story continues to kind of weigh on the broader market today. And it's interesting to see Palantir sort of hovering around that flat line, but again, struggling off the back of that announcement from U.S. Defense Secretary Pete Hegseth about defense spending being cut by 8%. As we head to break, I also want to take a look at the SOX index here. I was looking at the SOX index year to date. This covers a lot of those semiconductor names. You've got Intel as the best performer year to date, up nearly 19%. It's also, by the way, the only stock in the green today that is in the Philadelphia Semiconductor Index, as a lot of the chips names under pressure off the back of those Nvidia earnings here. Again, Intel up nearly 19%. You've got onsemi down 22% year to date, and Skyworks down 25% year to date. Some of the other worst performers in there, you've got the likes of Broadcom, AMD, and Marvell. The stocks, of course, we will continue to monitor. Much more ahead here on Catalysts.
Tesla shares right around the flat line here today after the company's market cap fell below $1 trillion earlier this week. Now, this is the latest losing streak that we have seen, erasing nearly all of Tesla's post-election gains. You're looking at, even over the last 5 days, the stock has been under a decent amount of pressure over the year to date. You're looking at losses of just about 28%. Joining us now to give a bit more context on what's behind this change potentially here, at least sentiment-wise for investors, we want to bring in Craig Irwin. He's a Roth Capital Partners senior research analyst. Craig, talk to me about some of the selling action that we have seen. Obviously, it comes after that massive run-up, so we have to put that in context. But what's your big takeaway from some of that pressure?
So there was a little bit of euphoria in there, right, with the election. Politics played a big role in the run-up, and they're playing a role in the rundown, right? Investors would come back to more fundamentals. The quarter itself, when people looked at the quarter, was taken very positively because of progress on the robotaxi and the next generation platform they're launching. But the fundamentals in there were positive growth versus 20 to 30%. That's a big miss. And then obviously the margins were disappointing for many out there, although we had pointed to the impact of battery materials really helping them in the upside they saw in the third quarter last year. So, it's just it's very, very volatile because of its status more or less as a meme stock. It's a retail darling, and I think as people start to refocus on the new platform and the launch of the cyber taxi, we could start to see some positive action. And then my traders, my technical analysts are pointing to the fact that it's come back, it's retrenched to its Fibonacci level. Usually those are pretty attractive levels to buy a stock that trades a lot on fundamentals. So we're bullish here. We think there's good news coming. And people are getting upset about January numbers. It's really the March numbers that matter for sales. Most of their sales are really in the third month of the quarter.
Craig, I'm going to mirror something that my colleague Julie Hyman said to me today that I thought was brilliant. If a stock is a retail darling and it starts to lose favor with the retail investors, isn't that a risk to the stock long term? And I'm specifically referring to Elon Musk's political leanings as a headwind to the stock.
Yeah, I mean, listen, I cover emerging growth companies, and I've covered them for 25 years, so I watch this very closely. Musk is up to big things. He's obviously having a lot of fun working to try and make a difference for the entire American economy, for everybody in the country, not just producing great vehicles that sort of transform the outlook for transportation, which is what he's done with Tesla. So, there are people that are happy and people that are unhappy there. If he's successful, the size of this halo that he's been wearing for the last 15, 20 years will increase by an order of magnitude. So we've all got to hope he's successful because it'll help bring down taxes, help improve growth, do some really amazing things for the economy. There's always short-term winners and losers when there are changes made. So, how does this impact him long term? I'm gonna bet in the crowd that this is actually something that does improve his status and improve his overall affection from the public and the retail investors. And let's hope, because it'll benefit all of us.
That's interesting in the context, too, of some news this week. The American Federation of Teachers is pressuring asset managers to divest from Tesla. That's about 2 million investors with $4 trillion in assets. If they are successful and if that becomes a trend, how would that not put pressure on the stock?
Well, think about it. I mean, there's a big conversation in D.C. about shutting down the Department of Education. I mean, we're like 40th in education worldwide, and we haven't improved in the last several decades, outspending everybody by massive margins. So, I love teachers. I've had some wonderful teachers.
I'm less speaking about the teachers
years.
specifically and more just about investors pulling their money from Tesla. Like if that becomes a trend.
There will be investors come in. There will be investors come out. People will try and exert their political muscle. And there's going to be a tug of war. There's definitely going to be a tug of war. So, if you see some of the pension funds pull out, you'll see others come in. And that's been, that's the way this works over time. There's buyers and sellers that make a market. And, if you're kind of on the losing end of some of these moves that are largely political, I can imagine there's going to be a lot of, contention, right? People will be aggressively looking to take action for their own best interest. And I'm not saying they shouldn't do that. I'm just saying on balance, I think, let's all pray and hope that he's very successful in what he's aiming to do, because it'll really impact the broader economy and obviously lives of everyday Americans.
Craig, how big of a distraction is Musk's role in the administration to you?
Distraction to me, for Tesla, not much. For him to Tesla, maybe it's a good thing because,
Why?
the people, like, he has some very, very good people working for him. And he's known for being difficult to work for, right? I like to call him unreasonable, as in being someone that doesn't take a no. You get something wrong, you come back and say, this is what I'm trying next. Other people that he's fired do not have nearly as pleasant words. So giving competent people a little bit more leash to work with and a big mission sometimes actually makes them more successful. So, at Tesla, maybe it's improved focus. We don't really know. There are some major transitions going on in the EV world right now with, obviously swings in demand that started during the Biden administration, and then the price adjustments, the subsidies, the ZEV credits, all these other good things going through substantial, evolution in the market, positive evolution for the long term. So maybe it's a good thing for Tesla that he's off doing bigger things that he's having fun with. I think it's quite probably the case.
Craig, I love that take because that's not really one that we get too often. And I guess my follow-up question then to you, two parts, is one, who are the biggest drivers then just in terms of the direction at Tesla without Elon there on a day-to-day basis? And then two, does that at all shift the strategy or direction or initially what you saw in terms of Tesla's growth here over the next several quarters or years?
So I don't have a good dialogue with people internal at Tesla, right? There's compliance issues around that, and I've been bearish and I've been bullish, and I work independently. So I talk to a lot of former employees. One of the three largest buyers of batteries in the world. I won't, if I get more specific, right? We know who it is. It's a good friend of mine. Called me yesterday. I talk to a lot of different people that are involved, right? And what I'm hearing is positive, right? This new vehicle platform is something I've been asking for since 2019 when they punted, right? They've also started to open the stores in India, finally, right? That should have been done years ago. The biggest strategic fumbles at the company in the last, since its founding, frankly. We're not going into India and not launching the mini car. And yeah, the mini car would have been margin dilutive, but it would put them in a very different place today. So, they're doing the right things. And speaking of the right thing, right, one of the things you flagged ahead of this was Mons, right? Mons is the crown jewel of stacking equipment for the battery industry. They've had the best quality equipment globally for decades if you want to make batteries. And lo and behold, pricing out of China, they've gone the same way as most of the other PV equipment suppliers out of Germany did, right? And now what is Musk doing? He's doing the right thing for Germany, the right thing for the industry by propping it up, by investing and supporting the jobs in Germany, the continuity of the intellectual economy around, a very important capability that is strategic. And the governments might have got there late, but Musk is doing the right thing. So, if that's what he's doing across his businesses and if that's what he's doing in government, that size of that halo is only going to get bigger. And, the long run for Tesla could be very, very exciting.
All right, Craig, always great to get your insight and talk to you. Thanks so much for joining us here this morning. And Tesla shares rebounding a bit today. You're looking at gains of just about 0.3%. Well, as we head to break, let's get a check-in on the major averages as well as Nvidia, the big driving factor. One of the driving factors in today's market action, of course, the uncertainty coming out of Washington, threats of more tariffs from the Trump administration, reversing some of the gains that we initially saw here. You're looking at the NASDAQ off just about 0.4%, S&P now actually back in positive territory as well as the Dow. You have Nvidia, though, still off just about 3%. We'll be right back.
Amazon Web Services entering the quantum computing race. The tech giant unveiling its first quantum computing chip, dubbed Ocelot, on Thursday. That announcement coming as more names in big tech are entering the space. Joining us now, we've got our own tech editor, Dan Howley. Dan, what can you tell us about the latest quantum news from Amazon?
Yeah, this is Amazon's first chip, and it comes after Microsoft obviously announced their own quantum chip. Google announced their quantum chip back in December, so last year, I guess. And really, this is these companies trying to already elbow each other out of position and try to get the lead in quantum computing. Don't forget, by the way, IBM's been doing this forever. I mean, they have quantum computers of their own, but this is the big tech giants, the big cloud providers trying to get ahead of the kind of quantum race. And ensure that they are the leaders. So what we have here with Ocelot is basically a form of correcting issues with quantum computing. Now, not to go too far in the weeds, but the big deal with quantum computing is that instead of bits, which classical computers use, those are the ones and zeros that translate into the apps that you see every day and how this is being streamed to you right now. They use qubits, which, because of quantum mechanics, rather than being 1 or 0, exists as both 1 and 0. So I know it's wild, but because of their nature, they're also very fragile, and so they're prone to errors, excuse me, if noise such as other atoms or something are introduced into their area. And so this is a form of trying to correct for that, to ensure that the qubits don't degrade and the information on them isn't messed with. And so this is what Amazon is pushing when it comes to Ocelot, this ability to correct those errors. And they're saying that this could help push quantum computing closer to becoming a reality. Now, that's been a big discussion. When do we see practical quantum computers? I mean, I've been reading articles from 10 years ago that said they're just around the corner. Sundar Pichai recently said 5 years. Obviously, Satya Nadella also saying that it'll be closer. NVIDIA's Jensen Huang had said a couple of decades, maybe still. Other experts are also torn on where this kind of actually becomes something that you can actually use. But just to give you a broader overview, the idea behind quantum is because they use those qubits that can exist as 1 and 0 at the same time, they can complete operations that would take classic computers tens of thousands of years to complete in sometimes minutes. So this is kind of the future that they see.
Dan, real quick, we only have about 15 seconds, but I'm just curious to get your take, just the different timelines from some of these larger tech leaders.
Yeah.
Isn't that a bit perplexing? Like they could
No, because I remember, maybe 8 years ago or 10 years ago, sitting at CES and having Ford be like, tell you what, guys, self-driving cars, 5 years away. You'll be having a mimosa on your way to work. Well, maybe not on your way to work, but whatever. Sitting in the back seat watching a movie, and the car is just going to drive you around all over the place. And I'm still driving around in my Honda, not sipping mimosas on the way to work. So it's, the companies like to push it. They're going to say that it's going to be faster than maybe it actually is, get everybody hyped up. I don't know. I still think that this is quite a ways off, and as far as I can tell.
All right, I love the analogy there. That we can all relate to. We could all strive for one day. All right, Hallie, thanks.
Thank you.
YouTube star MrBeast is reportedly looking to raise hundreds of millions of dollars in a funding push that could value his holding company at roughly $5 billion. That's according to Bloomberg. Now, the round will fund a holding company that has a stake in several businesses, including the social media star's video production company, as well as 2 packaged goods businesses, Feastables and Lunchly. Now, MrBeast is the most subscribed account on YouTube with over 350 million subscribers on the site, where his content centers around challenges and giveaways. Is the eye-popping $5 billion valuation potentially here, Maddie? And you talk so much about the creator economy and what goes into it, but the fact that this is even on the table just really speaks to how much, one, the media industry has changed, I think, two, and then two, just I was asking who was adding to this money, who was funding it, which I think is a big question going into this.
A question that would be great to get answers to, because it could add to the validity and the kind of efficacy of this investment here. here, but it is so interesting to see just the degree of success that MrBeast has had. This comes as Google has announced today that on YouTube, 1 billion people are watching podcasts every single month. So their investment in podcasts on platform are really successful. 1 billion is just a huge number, obviously. Also, in the context of MrBeast's success on Amazon with the Prime Video series he launched, it was the most watched unscripted series ever, according to Amazon itself. So that's not just according to MrBeast. Amazon had committed $100 million to the first season, and then now they're in debates over what that funding is going to look like moving forward. It's not for me. I don't like guy shows. Yeah, not for me.
Maybe one day.
Maybe one day.
All right, coming up next, it's Wealth. It's dedicated to all of your personal finance needs. Brad Smith has you for the next hour. We'll see you tomorrow.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Podcast that will make you a smarter investor.
Welcome to Stocks in Translation. I'm your host, Jared Blickery. Welcome to Financial Freestyle.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Welcome to Trader Talk, the podcast that dishes out the market straight up.
Welcome to Capital Gains. I'm your host, Madison Mills.
Welcome to Word Money. I'm Patrick Murphy.
And I'm Dan Coons.
From Wall Street to Main Street to the C-Suite, we are your daily lifeline, because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
It's time for Yahoo Finance's Market Minute. Stocks are mixed as Nvidia's decline weighs on the S&P and the NASDAQ. Speaking of Nvidia, shares are down over 3%, pairing gains it saw in pre-market trading. Analysts raising concerns about Nvidia's gross margins outlook. Meanwhile, CEO Jensen Huang touts strong demand for its Blackwell chip. Investors are optimistic about Snowflake's AI adoption outlook, rewarding that stock with a nearly 10% boost today. Software company projecting better than expected revenue growth for 2026, signaling growing demand for its AI products. And Salesforce edging lower after issuing a disappointing outlook for the year. Its new AI product, dubbed Agentforce, is expected to make only a modest contribution to revenue. That's your Yahoo Finance Market Minute. For more on what's trending on Yahoo Finance, scan the QR code below to track the best and worst performing stocks of the session.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, the tools, the tips, and the tricks that you need to grow your money. Hey, on today's show, Nvidia's quarterly results. We're tracking Nvidia's performance through a technical and fundamental lens to evaluate what you should do with the stock. And your new iPhone, is that screen cracked or the battery dead? Well, guess what? I'll be joined by Yahoo Finance's tech editor, Dan Howley, who will give his review of the new budget-friendly Apple iPhone 16e. Plus, getting retirement ready. All week long, we're taking a look at how to best invest for retirement at every age, from workers in their 20s maxing out their 401k match to those over 70 living off of their investments. And today we focus on your late 60s. We'll discuss the financial checklist that you need to make before you retire. All that and much more during today's show. But first, our top story of the day, shares of Nvidia under a bit of pressure despite beating analysts' expectations on the top and bottom line. We're going to zoom out and take a look at the stock on a technical level to determine whether or not it's a good investment for your portfolio on the pullback that we've seen here. Joining me now, we've got our markets and data editor and host of Stocks in Translation, Jared Blickery. Jared, what is the technical analysis telling us?
Let us start with the definition. Technical analysis is a method of evaluating and forecasting future price movements of securities by analyzing historical price data and volume data. Now, this it relies on charts and other tools to identify patterns and trends that can indicate future behavior. And let's take a look at a chart I have here. This is Nvidia going back 2 years. You might be able to see these little green dots. Those are earnings announcements. And one of the things we've seen with Nvidia is that it can catalyze price up or down. And today it happens to be to the downside, but there were various times, and it's hard to see, but there were some times when it catalyzed price action movement to the upside. And in fact, before yesterday, the prior earnings reaction was a brief foray into new highs after being reversed. And then we saw this technical pattern here. So let me get to one of the forms of technical analysis, which is pattern recognition. I'm going to draw a trend line in here. This is still intact. And we also have a broadening megaphone. And this is a pattern where you see increased volatility and uncertainty. Bottom line is that we're seeing more indecision. Now I'm going to add another layer. This is a moving average. This is a 200-day moving average. And if I extended this chart to the left like 10, 20 years, you would see that the 200-day is a very good capturing device of the predominant trend. What you'll also notice here is we just broke below it, a little whoops moment in the recent past. And today we are bouncing off of it again. So suffice to say, Nvidia is at a decision point. So that was the 200-day. I'm also going to introduce the 5 DMA, and that's a 5-day moving average. We can use the 20, we can use the 50. The 5 I like. This is because of Brian Shannon. He wants to see price above it if he's going to initiate a long swing position. That's holding for a few days, a few weeks, maybe in a few months. But that is something that we're not seeing today. So the long-term trend is up, the short-term trend is down, and so we need to make a decision. And guess what? RSI can help us do that. That is relative strength index. The squiggly line down here goes from 0 to 100, and then we have overbought and oversold areas, which is above 70 and below 30. What I notice here is that we have not been in an overbought or an oversold status since June of last year. This is no man's land. This is indecision land. So more heightened uncertainty, and that's what I'm getting from this chart. Now, you put it all together, if I'm going to get long, I would want to see a cross over this 5-day moving average. That would bring it in line, the short-term trend in line with the longer-term trend. Ideally, though, I would like to see a little washout of the week longs, and so maybe we dip below the 200-day a little bit, and then we quickly reverse to the upside. That's a pretty strong buy signal right there. If we just get back to the record highs here and are able to extend beyond it, that's also a long signal, but then you have a wider stop, or it's more difficult for risk management at that point. So the bottom line is today we're kind of at a decision point below the 200-day moving average. If we close there for a few days, this rally is in serious jeopardy. Back to you.
Jared, thanks so much. And you can catch more of Jared on Stocks in Translation every Tuesday and Thursday, 8:30 a.m. Eastern Time on Yahoo Finance or wherever you get your podcasts. Nvidia under some pressure here, despite that upbeat earnings and the outlook for its first quarter margin did miss estimates. That's coming into focus, and we want to look at the stock's performance using some of the fundamentals as well here. Whereas technicals focus on timing and analyzing price movements to time market decisions, fundamentals, they focus on value and assess a company's financial health through earnings and revenue. Here to help me do just this, we've got on set Jay Woods, Chief Global Strategist at Freedom Capital Markets here. So Jay, there are three fundamentals that you're looking at around NVIDIA. What are they?
Well, first was the earnings overall, but we look under the hood, we look at that revenue beat, which was good. They consistently beat on revenue, and we look at the chip, the Blackwell chip. People were concerned, is the demand still there? Jensen addressed that. The demand is still there. There were no snafus as far as deliveries go, so we checked that box. Revenue beat, Blackwell, things, looking good. So that was optimistic. The DeepSeek question. DeepSeek is the one question on everybody's mind. This is what drove the stock price down late January, early February to that 113 low. Is this competition good? Is it going to hurt their growth going forward? Jensen welcomed it. Did that resonate with investors? It doesn't look like it's eased anyone's concerns that this competition will be good. How is that China trade going to be going forward? But Jensen didn't say this was going to hurt them. He welcomes the competition, and he doesn't see it being a headwind. And then lastly was, that CapEx spending from its biggest, users of the platform, the Amazons, the Googles, the Metas. There hasn't been a slowdown. We saw that with their numbers. The projections, though, the guidance going forward, that has been the bugaboo for not just tech stocks, but all stocks. You look at Walmart, they had a blowout quarter. They guided a little lower. Nvidia, we're used to blowout quarters. We got it. This was fantastic. Was it as big? It was the worst revenue beat in 2 years, but they beat. And the guidance was solid. But what is hanging over this stock right now? It's tariffs. So when you look at Nvidia, the stock, phenomenal. It's a juggernaut. It's best in class. Its growth projections continue to be strong. What it made in the last year is almost what it made in the last 10, or its first 10. So we're seeing the growth, but it's not impressing the street, and we're concerned right now, and you see it in price action. As a technician as well, I think Jared did a great job of pointing it out. We are not rallying right now. We're kind of stuck in this level, and that call didn't give us that catalyst. So what is the next catalyst? In March when he presents at his annual conference. So we'll see what he says then. But right now, investors are kind of like, all right, this didn't wow us, but we're not panicking, we're not getting out, so we're kind of just stabilizing here, waiting on tariff news.
The commentary from UBS out this morning also kind of mirroring what you were mentioning here in the big four U.S. tech firms. They're all forecasted to grow by 35% in terms of some of the CapEx spending that's coming forward there. But that points to something else, which is the solid AI adoption trends. They believe it's going to continue to boost monetization here. How does that play into the fundamentals, and how much of that goes strictly to NVIDIA versus the rest of the competitive landscape?
Exactly, and it's a competitive landscape. I think that is the key word. We're starting to see more competition, and then there's concern that this CapEx spending isn't getting the results that people want. They may have to draw down. What does that do to NVIDIA's bottom line when their biggest customers are starting to wean back? So that is the cloud that's overhanging it. But when you look at the quarter, when you look at the results, they knocked it out of the park. But it wasn't this blowout that was going to take us to the next level, because there's still too many concerns, geopolitical concerns, that are weighing over this stock. So when you go back, you look at the technicals, and that story shows that we're kind of in this no man's land. And if we do break down, as Jared pointed out, then you want to watch that 113 level, the lows we got after the DeepSeek news broke and took us down there.
Jay, thanks so much for joining us. Appreciate it. Coming up, everyone, considering buying an iPhone 16e, we're giving you the rundown on what you need to know. That's next. Let's take a look at some of the market action right now as we are just under 2 hours into the trading session. The Dow Jones Industrial Average higher by 0.8%. The S&P 500 flat just barely to the upside, but the NASDAQ, that is lower right now. Some pressure from Nvidia after those earnings report. And then additionally, taking a look at the decline here, it's down by about 0.4%. That is following those fourth quarter results from Nvidia. Joining me now, we've got Robert Pavlik, who is the Dakota Wealth Management Senior Portfolio Manager. You're looking at a variety of factors here, Robert, that are driving the recent volatility we've seen. What are they?
So, I mean, you have inflation. Inflation doesn't seem to be ebbing at all. You have concerns about growth of the overall economy. Retail sales report, the Walmart report, that's concerning people. Tariffs are concerning people. Trump is talking about raising tariffs not only on, China, but Mexico and Canada. He's talking about reciprocal tariffs. I think all those things came together, especially with a market that was trading around, 23 times. And, you had a lot of run up in some of these big momentum, highly traded trader type stocks like AppLovin and Palantir. And I think that all sort of came together at one point, and people started to, move to the exit, and, selling begets more selling. Is it a problem for the overall economy? I mean, growth is certainly, small. It's being reduced. I mean, we're looking at GDP of 2.3%, something like that. I had been saying, even since I've been on since January, that I thought GDP growth was going to be 2 and 2.5%. It's not the worst. I mean, it was kind of like what we experienced during the Obama administration. We were growing and the market did okay, but you're not just seeing it go gangbusters. You have to sort of really pick your spots in this market.
And so with that in mind, and it sounds like a lot of the economic inputs that you were mentioning can also contribute to what we heard one of our guests from Stifel earlier say, prepare for a wobbly stock market as a result of that. What would you use to describe what type of fluctuations we're expecting to see over the course of this year?
So what worked all sort of last year, is probably won't work all this year. You're not going to have all these big Mag 7 type of rallies that are going to carry the overall market.
It's already the long trade right now.
You have to actually do your work and find companies that are good quality names depending on your risk tolerance. If you have a high degree of risk, then maybe, an AppLovin, a Palantir, a Snowflake matches into your portfolio. But if you're like the rest of us, I mean, who, are somewhere between, 5 and 7 on a risk tolerance of 1 to 10, you're probably looking at, names that I've suggested in the past, like Costco, like Google or Alphabet, or like TJX or AJ Gallagher.
Yeah.
I mean, these are good, solid names that are doing really well. And nobody talks about them in the market. Nobody ever talks about AJ Gallagher except when they report. Nobody ever talks about TJ Maxx except when they report. So these are the types of names that I look to put into my portfolio right now.
And so how does that factor into the barbell approach that we're increasingly hearing strategists talk about right now?
So I think you can have some exposure to technology. You don't have to have, these crazy high beta names in your portfolio, but you could put Apple in there. I think Apple is a solid company. It's not growing tremendous amounts. It's not the cheapest stock in the overall universe, but it's a good quality name that I don't think you have to really worry about losing sleep over. You could even sort of expand your horizon and maybe add a little bit of risk to it with like an ANET or even a Broadcom.
Yeah.
But just know what you own. Then I think you have to look towards, what else do I put into the portfolio? A lot of activity has flowed into the healthcare space. Now, look at things like Merck recently. Merck, has been a terrible stock, terrible performer. And all of a sudden, over the last week or two, the stock has spiked up. Everybody's got to own Merck. For what reason? I wonder, and I shake my head at some of those trades. But I think if you look towards, some other names in the healthcare space or even in the consumer discretionary space, you don't have to take on a whole bunch of risk.
How do you identify an exhausted trade? You mentioned AppLovin and brought that to mind here. That was a name that's been up, 400% over the past year here, and ultimately it's pulled back quite a bit from some of those highs that we've seen as well. And a lot of people trying to figure out, okay, with that pullback, is the trade fully exhausted at this juncture because of the beta that you were talking about? And how do you kind of use that as your analysis on a wide range of stocks?
So I think the best way to answer that question is to look at the sort of the technicals, has the stock spiked up well above its 200-day moving average? Is it sort of out of its trading range? Is it does it have an RSI that's completely off the charts? Now, if you're taking a look at those types of stocks, which we saw like 2-3 weeks ago, and you're thinking, well, I can't add this to the portfolio. We're constantly reviewing the names in our holdings, and we're constantly looking for new names or possible better names for the portfolio. So there really wasn't much there to be interested in. But I think if you come back to, again, like a TJX or AJ Gallagher might even be a little bit extended. I wait for a little bit of a pullback, but TJX looks pretty decent too.
Just reported earnings.
Yeah, exactly. And Gallagher just reported like a couple of weeks ago. So again, quality names, nobody talks about them. It's not within these traders, universe that are going to run them all up and then, bail at the slightest bit of concern.
Yeah. Robert, great to have you back.
Thanks for having me. I appreciate it.
Good to speak with you. Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, let's talk a little Teladoc Health, plunging after reporting a wider than expected loss and disappointing guidance. The company's fourth quarter revenue falling 3% from a year ago. Last month, Teladoc announced plans to acquire preventative care company Catapult Health in an all-cash deal for $65 million here. That deal is expected to close in the next few days. And Virgin Galactic rising after announcing plans for its return to space after a nearly 2-year hiatus. The company says its first space flight with new Delta spaceships is planned for summer of next year, rather. That flight will be carrying research materials before the company plans to begin private astronaut space flights in the fall of next year. Shares higher by about 5.4%, excuse me. Well, it's time now for Tech Support, our weekly look at what's new in the world of smartphones, computers, and more. Apple's new iPhone 16e will be available Friday. The smaller phone comes at a price point just $599, a budget-friendly option there, and our own Dan Howley joins me now to tell us 3 things that you need to know about the iPhone SE here. 16e.
16e, Brad. Get it right or pay the price. That's from...
Not to be confused with the SEs out there.
No.
Yes.
To salute your shorts quote, by the way, for all those old Nickelodeon watchers. This is the iPhone 16e. You can see it right here in my incredibly handsome hands. You'll notice that it does look like the iPhone 14 or older, looking at that phone that you have there, Brad. It's got, on the back, one single camera. That's probably the biggest standout that you're going to notice. It doesn't have a wide angle, ultra wide angle, just a wide angle. It does have a kind of optical-like zoom. It's 2x, but it's nothing that's going to, absolutely blow you away. But there are a few things that I think are worth talking about as far as this phone goes, and that includes the fact that it comes with Apple's first C1 modem. The C1 modem is honestly not a life-changing difference for most users. I was running it on my phone. I was getting speeds in my apartment that were faster, frankly, than my home internet on Fios. But I usually get that on my regular phone as well. So, the 16 Pro. So it's an Apple change, but not necessarily a consumer change. Over time, though, Apple says this will get better battery life as a result, and then will allow them to customize designs a little bit more. But for most people, it's not that big of a deal. The other thing is it has Apple's A18 processor. Now, when you would get the older SE, you wouldn't necessarily get the latest processor. You would also get a design that frankly felt outdated. And while this does have the design of the 14, it does feel a little newer. The A18 chip, by the way, also means you get access to Apple Intelligence.
Interesting.
For whatever that's worth right now. I use Apple Intelligence, totally honestly. The summaries are cool. It'll summarize your notifications with people. It'll summarize some news notifications. That's been a little iffy. But I do like the notifications with texting back and forth with folks. That's actually genuinely helpful. The writing tools, not going to use. I'm a writer. I don't want to do that. And I think some of the other tools aren't necessarily huge. I will point this out, though. Visual intelligence is pretty legit. I've used it because for Valentine's Day, I got my wife a bouquet because I'm the greatest husband on the face of the earth. And my friend had been like, well, just make sure nothing in there is poisonous to cats. So I used visual intelligence to look up what these little berry guys were. Hold on.
There we go. Okay, we're testing the camera. That's what people buy the phones for. Price point. Is this a good phone at the price point?
$599. It's a decent price point. It's more expensive than the 429 that the original SE was. So you're getting a price bump, but you are getting more storage. You're getting wireless charging. You're getting an improved display. I think this is worth the money if you're an iPhone fan. Let's face it, most people are iPhone or Android. They're not going to go and get an Android phone just because this is a little bit more expensive than the SE. I think this is a great phone for the price. My brother's looking for a phone. I'm going to recommend that he buys it. It's not going to have all the bells and whistles that you would have with the 16 Pro, but it does get the job done for $599.
All right, lightweight too.
It is, right?
All right. You cooked me on my 12 Pro Max, so
Sorry.
I guess I got to get into a store and upgrade now. Dan, thanks so much.
For sure.
Appreciate it. Coming up, everyone, we're continuing our look at how to prepare for retirement, plus a change to Social Security that's coming forward. That is next on Wealth. Stick around. The Social Security Administration has a lot of big moves coming your way here. But first, as we think about what those changes are that are coming your way, we want to pivot and talk about retirement here, especially as we consider how every generation is preparing itself for retirement right now. We're going to take a quick look at the major averages here. We've got those on your screen as we're just about 2 hours into the trading session. And the Dow right now is up by about 0.9%. The S&P 500 is up 0.1%. And the NASDAQ, we're taking a look at that, holding on to some slight moves higher here. Actually, that's looking like it's down. Our arrow is just pointing the wrong way. It's down by about 0.4%. All week long on Wealth, we've been covering investing for retirement at every age from the beginning to the end of your career. Today, we're breaking down the mid-60s, the time when most people start thinking seriously about leaving the workforce. The so-called silver tsunami is underway with a record number of Americans turning 65 this year. 4.18 million seniors are expected to hit that milestone in 2025. Joining me now with some advice for the incoming wave of new retirees, we've got Rita Asaf, who is the Fidelity Investments Vice President of Retirement Offerings. Great to have you here with us, Rita. So first and foremost, let's talk about this silver tsunami. What are some of the figures and how many people are we anticipating will be a part of this so-called tsunami?
Well, I think as you just noted, we're hitting sort of the peak number of those turning age 65 right now, which will continue to through 2027. And what we know is that by 2030, almost all baby boomers, I think all 71 million, will be over the age of 65. So it is definitely a tsunami, and it's coming very quickly.
And so as you think about how much you should have saved by your 60s, what is kind of the good, and I know the number is different for everybody, but perhaps what is a good barometer that you're seeing be more widely used among this age cohort?
Yeah, the number does vary. Everyone wants a number. What's my number? And it really does depend on your personal needs and what you plan to do in retirement. But ideally, what we say is that you should be able to replace, with your savings, about 45% of your pre-retirement income. And you want to try to withdraw no more than 4.5% of your savings each year. Now, this could be adjusted up or down depending on when you retire, if you retire earlier, if you retire later. But that's the general guideline.
And so if you're in your mid-60s, what's your checklist for retirement to make sure you're ready?
Well, now that you're that close to retiring, you really need to get to brass tacks. So first, I would say identify your personal financial goals and create that detailed retirement income plan. You want to determine if you have enough money to last throughout your retirement. So example, where do you want to live? What will you be doing? This will help you identify those expenses that are essential and non-essential. And ideally, you want to have essential expenses covered by guaranteed income sources, such as Social Security or annuities, because these keep up with inflation. And then discretionary expenses should be covered by either your savings or investment income. So that way, say there is a market downturn, you can cut back without hurting your day-to-day. Second, take a look at your Social Security and your claiming strategy. That is one piece that's key. We know that if you wait to delay to claim, you can actually get more, your monthly payment can increase. So you want to understand that, and then how your portfolio is allocated towards emergency savings, income protection, and growth. Third, you want to implement that plan with an appropriate mix of what those investments will look like in each bucket. And then lastly, you'll want to continue to review it. For some, retirement is lasting upwards of 30 years. So we know things can change, whether it's in the market or your personal goals, and that's where it's important to continue to revisit your plan.
And so all of this in mind, how should you be shifting your investments when you are in these years and really kind of getting down to brass tacks with your retirement planning?
Well, it's easy to say you're probably less aggressive as you head towards closer to retirement. And we know that retirees are often looking at trying to become conservative with their short-term investments during this time. And that is tempting, but you don't want to get too far down, too conservative or too aggressive, because given that retirement may last longer with longevity and healthcare innovation out there, you might need to actually build in some growth potential. So you'll need a balanced portfolio that keeps in mind some short-term investments that you can use for your day-to-day living, but then some growth potential that can help you. So for conservative investments, you'll want to really look at anything with a fixed return, such as a CD or annuity, and then anchor that with some growth investments that can withheld and grow with inflation if that actually occurs.
Okay, and while we have you here, required minimum distributions, known as RMDs here, what do we need to know about this?
Well, as you save in those tax-deferred pre-tax and retirement savings, at some point you do actually have to take that money out through what we call required minimum distribution, which right now is at the age of 73. That will increase per Secure 2.0 in 2033 to age 75. So the deadline for taking RMDs is generally December 31st, although in the your first year that you take RMDs, you can actually delay that to your second year. But this is where, when you're taking RMDs, you really need to consider your tax liability and how that impacts things, because there is a tax impact to RMDs, and it does create, RMDs are treated as taxable income, which can have a domino effect depending on what that means to both your Medicare premiums and other factors that you have from other income. So you want to just be careful of how those RMDs factor into your tax strategy.
Really great breakdown. Rita, thank you.
Thank you for having me.
The number of retirement account millionaires surged last year, according to the new data out from Fidelity. With more details on what drove these gains, we've got the senior columnist here at Yahoo Finance, Carrie Hannon. Carrie, what do we need to know?
Hey, Brad. Yep, great news for millionaires. It jumped. Fidelity's numbers showed that last year, a 27% jump in millionaires who are 401k millionaires. This is, great news on many levels, and we can explain it because, oh my goodness, we had a pretty robust economy last year. Inflation was easing, the interest rates dipped down, the Fed cut those rates, the S&P was up something like 23%. So there was a strong market behind these numbers. And what we found is that, or what Fidelity found was 4 in 10 of these millionaires are boomers. 57% of them were Gen X and 2% were millennials. And the reason why boomers weren't number one is because they've already started to pull some money from these retirement accounts to use in retirement. But Brad, you got to understand, the reason why these folks have become millionaires is, yes, we had a great year last year, but they have been saving on average for 26 years. And they have put in an average of 18% contributing every year. So that's 18% pre-tax, and that combines employer and employee contributions. That's a lot. And so it's steady, consistent. It's a long-term game. If you want to become a 401k millionaire, you got to be in it for the long haul, be consistent, and keep contributing. And that will make all the difference in the shaky markets. When the markets get volatile as well, you stay the course.
And so, Carrie, there are some people out there who might be getting a bit worried that they don't have $1 million in that 401k. What's the average balance in those retirement accounts? We've got a couple seconds here.
Oh, shoot, 131,000 roughly for 401ks, 127,000 roughly for IRAs. But, Gen X has, 590,000 roughly. So those are average numbers. And you got to remember, people are ticked up. They actually did start contributing more last year, 14.1%. So it's still below the 15% most advisors tell people to set aside pre-tax, but it's getting better.
Carrie, thanks so much for taking the time and breaking this down.
Thanks, Fred.
Coming up, as President Trump threatens to impose tariffs on China, Canada, Mexico, and more, how could that impact the goods that you buy every day? I talked to the CEO of The Honest Company about that and much more next on Wealth. Consumer goods brand The Honest Company beating expectations in its fourth quarter and reaching a record annual revenue of $378 million in 2024. That's up 10% year over year, and the company issuing guidance that it says takes into account the potential risks of tariffs. Investors are eyeing the impact these policies could have on consumer names and pricing for customers. Joining me now on this, we've got Carla Vernon, who is the CEO of The Honest Company. Carla, great to have you back on the program with us, and thanks for taking the time here. You know, as we're just monitoring the stock reaction to the earnings, just got to ask, even as you're looking out into the future, of course, investors focused on what's going to happen in the future for the company. How are you really factoring in the impact of some of the potential policy decisions that could come forward?
Thank you so much, Brad. It's really great to be here with you this morning, and I have been enjoying this series that you are doing on Yahoo Finance, so thanks for having me. We reported our earnings yesterday from The Honest Company, and across the board, we did beat expectations and beat consensus. I'm very proud of the record revenue results and the margin expansion that people are seeing from The Honest Company. As we gave our outlook, we did reflect what we knew and what we were able to plan for in tariffs. And I would say overall, our expectations for The Honest Company remain strong and confident. We indicated that we have our long-range model set to grow at 4 to 6% on the top line and margin expansion on the bottom line. And that remains our point of view. We're very confident about our ability to do that.
I wonder what you're hearing from your retail partners right now in the pulse check of the consumer, especially as it relates to all of the items that make their way into shelves at some of those largest wholesaler purchasers that you work with.
We have such strong relationships with our retail partners. The Honest Company plays such a strong role, both in brick and mortar stores and online, because we really attract a very new and important demographic to the aisles that we play in. So many people might not be aware, but Honest Company makes clean, designed personal care items that are designed for babies. And now we've expanded into families of all sizes and all ages, with products across the board, from diapers and baby wipes to personal care for adults, including gorgeous skincare products. And when we talk to our retailers, what we're finding is that they value what Honest brings by attracting that upper income household to the categories. And they see that we are driving growth in the categories where we play. In fact, across the board at our top retailers, whether that's Amazon, Target, Walmart, we've seen growth in consumption across all of 2024 and even our fourth quarter results.
Carla, while we have you, tomorrow is a critical event for retail as well here, as we know that Target, in some of the backlash to rolling back their diversity and equity and inclusion initiatives, there are customers that are saying they are going to black out, basically, their purchases from some of the retail organizations that have made these decisions. We know that you have partnerships with stores like Target. How do you kind of monitor when there are major events where consumers, as Marcus Collins told us yesterday, have more empowering agency with their dollars, to make sure that you're still kind of monitoring what's playing out with the consumer and how that agency also flows through to aisles that you're in as well?
The Honest Company was founded by 4 founders who themselves were diverse, including a Latina founder, an Asian founder. I myself am an Afro-Latina female CEO. So at The Honest Company, the importance of including everybody who might want and need our products is just absolutely woven into our DNA. I was trained at one of the world's greatest and biggest CPG companies. And one of the things I learned when I grew up inside of General Mills and when I was running the everyday essentials business at Amazon is that demographics are destiny. And consumer products companies need to have a big, wide open tent to attract everyone. To do that, we have to have products that earn that trust. That's what we focus on at Honest. We have products that have a very high standard of clean. We call it the Honest Standard. Mm-hmm. And we There are 3,500 ingredients we do not use or allow in our products because we want people to know these products are different on this shelf. They are high quality, they are effective, and they are good for everyone. I love when I see the 5-star ratings across the board for our products. That means we are actually satisfying people across the board. And our retailers look for us to do that, to bring everyone into the aisle and drive those sales.
Carla, just lastly, while we have you, I only have about 30 seconds here, but I love the history, the work history, the experience you bring to the Honest Company, just the leadership lessons, and you sent some leadership lessons to our team, especially as we're considering this critical moment for diverse voices and positions leading large businesses, publicly traded like the Honest Company.
Listen, my message to all of my employees and everyone right now is do a personal inventory. Make sure every day you are making space for gratitude, for joy, and for rest, because that will serve you in these times and in any times.
Carla, thanks so much for taking the time here out of your busy schedule. Really appreciate it as always.
Thank you, Brad.
The rollback of diversity, equity, and inclusion programs, or DEI, have affected a number of media companies, including Disney and Paramount. This means big decisions from many more corporate executives approaching this at a critical moment in media. Joining me now on set to discuss is Deborah Lee, the former CEO of BET Networks and author of the book, I Am Deborah Lee. Deborah, great to have you here in studio with us.
Thank you, Brad. Thank you so much for having me.
Absolutely. Let's start exactly on the point that we were making on the way in, talking about some of the rollbacks that we're seeing in media at large. What would you, if you had the ear of some of these executives, because I know that you've already worked with, or at least been in the same room with many of them over the years, what advice would you be giving them in navigating this critical moment?
To the executives that work at these companies now? Well, I think I would first say that they should dig deep inside themselves and figure out what their values are and why they joined the company they joined. I have always been a big proponent of diversity, inclusion, or opportunity, whichever you want to call it these days. It was very important to me growing up. I had opportunities I may not have had otherwise, but I excelled and I was able to run a company, BET Networks, for 13 years that was probably like 95% diverse. A lot of people came to BET because it provided uplifting programming to the Black community.
Absolutely.
All that said, I firmly believe that you should be comfortable where you work and your values should align with your company's values. I have been very fortunate to have a long career at BET, but also to serve on many different corporate boards. They're all doing some soul searching right now and saying, where do we go from here? And I'm happy to say most of the companies I know and are affiliated with have said, we believe in our values and we're going to stick to our values, no matter what the political winds of the year or these 4 years are. So I'm happy to see that, and I would encourage executives to ask their CEOs, to ask their board members what they believe in. Absolutely. And I'm a little saddened to see the companies that are rolling back. I hope they're not really rolling back, hoping there may be changing language or changing structures. But it's important, as Carla said, for companies to know who their consumers are, in the media space to know who their viewers are, and to try to cast that net as wide as possible and say, we want to give opportunities to all, and we want to deliver products to all, and in the media space, we want everyone to watch.
You had a major position in media, a ton of influence for years here. What advice would you give to young professionals, especially women and people of color, who aspire to lead organizations in media or entertainment?
Yeah, that's a great question. And that's one of the reasons I wrote my book 2 years ago. It'll be out in paperback next week.
Congratulations.
Thank you. And I wrote it because I looked around and I didn't see a lot of female executives, or very few female and hardly any Black female executives that were CEOs. The numbers are still really low. And I said, I want to explain and detail my journey so that hopefully young people can learn from it. Young people, men and women, can realize they can be CEOs, there is a path, and that they have the opportunities to do and impact companies. So I would encourage young people to become well educated. That's the first step. My dad always told me that. I was born during the year of Brown versus Board of Education, so I had opportunities that the generation behind me did not have. I went to the best schools I have, so best schools I could. So going to get your education is paramount, and then try to discover where you want to be, what industry, what kind of company, and if it doesn't work out, you can make another decision. But when you're there, if the COO, CEO, or the C-suite is on your radar, try to broaden your experience. Don't just be a lawyer who understands programming or understands marketing. That was my path to CEO. I went in as a lawyer. I kept picking up more business-related assignments, and I became COO, and then I became CEO, a path that I never envisioned for myself.
Everyone has to carve their own path along the way.
And it worked.
And it worked, indeed.
And I think it will work for others. That's why I want them to know about it. And DEI and all the restructuring in the media space, the competition between streaming and cable and broadcast shouldn't deter people. They should learn all the new technology and keep pushing for what they believe in.
Deborah, thank you so much for taking the time here with us in studio today. Great pleasure to have you in.
Great to be here. Thank you.
Coming up, everyone, wedding season is on the way, and with it, a big bill for many couples. We discuss next on Wealth. Wedding season is just around the corner, and for many couples, their wedding day could be one of the most expensive events in their lifetime. The average wedding costs, get this, about $33,000 in 2024. That is down a touch from the year prior, according to the wedding planning platform known as the Knot. As couples begin planning for 2025, 85% of them say that the economy will likely impact their plans or decision making. And some are even turning to the micro wedding trend to save some money. Joining me now, we've got Raina Moskowitz, who is the CEO of the Knot Worldwide. Great to have you here in studio. I mean, I've visited the websites of the Knot all the time. Too many weddings that we've gotten invites to, but for good reason as well.
Yeah, good reason.
Yeah, so great to have you here in studio. Let's talk about this. What trends right now are you seeing impact the costs of weddings? And it's not all inflation alone, is it?
No, sure. So first, thank you so much for having me. I joined as the CEO of the Knot Worldwide just over a month ago. And it has been really exciting to see the trends that are happening in this space. And so weddings are a big business and they're resilient. So despite inflation or economic pressure, we see that couples are really continuing to prioritize the big day and celebration. And so, yes, on average, weddings are quite expensive. We introduced a budget advisor tool last year as a way to help ground couples. And what I'll say influences the cost of a wedding geography, so where you get married. So, averages are a little deceiving, so it depends where in the US, as an example, you're getting married. Sure. In some places, the average might be 20, and some places in New York, New Jersey, closer to 70 and above. Ooh. And so that geography is a big factor. Mm-hmm. Also, guest count is a big factor. And so a lot of the decisions you make in planning the big day are variable costs that depend on guest count. But what we see is that on average, couples have 116 guests at their wedding, and that is holding strong. So despite pressure on budgets or wallets, we see that weddings are resilient.
And so with this in mind, how are couples alleviating costs right now? What are some of your top tips to cut down on costs here and there that could have a big impact for your experience?
Yeah, so on our platform at The Knot, we have nearly 900,000 vendors to choose from. And so we have vendors that serve couples based on whatever their style, whatever their budget. Mm-hmm. And what we see is that while couples are very mindful of their budget, on average, they continue to engage with 14 vendors. So they're not cutting out any element of their wedding. Again, guest count is a good lever to be mindful of. And also working with your vendors. So vendors have so much knowledge. So, if you're in love with a certain flower, as an example, and it's expensive, you can work with a vendor to find, something that's a good replacement for it. So vendors have so much knowledge, and it's really helpful for couples to lean on their vendor to make choices that fit within their budget.
I got to hustle to my finish here. I got 30 seconds. Outlook for 2025 in weddings.
Yeah, weddings are shining bright. So despite any headwinds, weddings are resilient, and Gen Z is all in on weddings too. And so we're excited about that data that shows that Gen Z continues to envision weddings in their future.
Interesting. Okay. All right. We're going to continue to track all these trends and much, much more. Raina, thanks so much for taking the time here with us.
Thank you so much. It's great to be here.
Absolutely. That's it for wealth, everyone. Let's take a quick look at the markets here with the time that we do have left. Checking in on the Dow, the S&P 500 and the NASDAQ. We're mixed right now. The S&P 500 down by about 0.25%. NASDAQ has continued to slip off of that Nvidia earnings report. That's down 0.8% right now. And you've got the Dow Jones Industrial Average. That is holding on to some gains. It's up fractionally by about 0.5%. That does it for our show. I'm Brad Smith. Thank you for watching. You can stay tuned for Market Domination. That comes up 3 p.m. Eastern Time. Julie Hyman, Josh Lipton, they'll count you down to and through the closing bell.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. podcast that will make you a smarter investor.
Welcome to Stocks in Translation. I'm your host, Jared Blickery. Welcome to Financial Freestyle.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Welcome to Trader Talk, the podcast that dishes out the market straight up.
Welcome to Capital Gains. I'm your host, Madison Mills.
Welcome to Word Money. I'm Patrick Murphy.
And I'm Dan Coons.
From Wall Street to Main Street to the C-suite, we are your daily lifeline, because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
It's time for Yahoo Finance's Market Minute. The Nasdaq and S&P 500 under pressure as Nvidia's fall weighs on broader markets. Shares of Bitcoin miner Marathon Holdings jumping after reporting record revenue in its latest quarter, boosted by the rally in crypto following the election of President Donald Trump. Warner Brothers Discovery shares rising as the company expects to grow its subscriber base for its Max streaming service to 150 million users by 2026, offsetting a miss on revenue in its fourth quarter. And Novavax shares higher after reporting a narrower than expected loss in its fourth quarter. The drug maker also says it expects its licensing deal for COVID-19 vaccines to generate royalties and reduce selling and administrative expenses going forward. And that's your Yahoo Finance Market Minute. For more on what's trending on Yahoo Finance, scan that QR code to track the best and worst performing stocks of the session.